The chair is authorized to declare a recess of the committee at any time. As a reminder, I ask all members to keep themselves muted when they are not being recognized. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may only participate in one remote proceeding at a time. If you are participating today, please keep your camera on. If you choose to attend a different remote proceeding, please turn your camera off. As a reminder to all members, we will conclude today's hearing. I believe I better check the time before I give you that time. Members who were unable to ask questions at our February 24th hearing with Chair Powell will be given priority to ask their questions today, and we will return to our normal order of recognition once those members have asked their questions. Before we begin, I will recognize myself to call up the resolution offered by Ranking Member McHenry, naming Republican members to subcommittees. Copies of the resolution were made available in advance. So without objection, the resolution is adopted. This hearing is entitled Monetary Policy and the State of the Economy. I now recognize myself for 4 minutes to give an opening statement. First, I would like to welcome back Chair Powell. We're delighted to have you with us today. Much has happened since the last time you testified on the Fed's monetary policy report in February. Since then, Democrats passed and President Biden signed into law the American Rescue Plan. Because of the American Rescue Plan, more than 58% of adults in the United States have been fully vaccinated and businesses are reopening. More than 3 million jobs were added to our economy in the Biden administration's first 5 months, the most in any president's first 5 months, compared to just over 2 million jobs created during the first 12 months of Trump's reckless tenure. And the latest jobs reports show that 850,000 jobs were added to the economy in June alone, a tremendous increase that beat market expectations. Simply put, without the American Rescue Plan and the extraordinary leadership from the Biden administration and Democrats in Congress, our economy would not be on the track to recover. But we still have more work to do to put this crisis firmly behind us and build a more resilient economy for the future. For example, while the unemployment rate continues to fall, joblessness remains higher for Black and Latinx workers than it does for white workers. To be clear, we will not have a full recovery without closing this gap. While inflation has risen in recent months, Chair Powell, you and other experts have attributed this to short-term factors. Consumer demand is way up, with people once again dining out, buying cars, and purchasing homes. But supply chains haven't yet kept up with this pace, which as a result has led to higher prices. I think the Fed is right when they say that this dynamic will subside, but I expect the Fed to continue to monitor high prices as it fulfills its dual mandate to promote price stability and full employment. At the same time, Congress should be considering whether it's better to address semiconductor shortages and soaring home prices through smart investments or face higher interest rates from the Fed. The COVID-19 pandemic disrupted life for all of us and shifted the way we think about the economy. We see this in the huge number of women and people of color who left the workplace. We see this in a generation of young people weighed down by student loan debt. And we see this in the surprising percentage of workers who have quit their jobs even as the unemployment rate remains elevated. We're in a moment of transformation that requires a fresh approach and investments that will close the racial, wealth, and income gaps, address climate change and our child care crisis, and finally, end homelessness. The Fed must also play a central role in this economic transformation. The Fed must ensure that our economy recovers equitably, reverse deregulatory actions that roll back rules for Wall Street, and shore up protection so that our financial system is less vulnerable to shocks. Whether by partnering with the Treasury to implement a framework focused on climate change and financial stability, exploring a central bank digital currency, and implementing faster payments, or strengthening its outdated approach to bank mergers, the Fed must fulfill its role in ensuring a strong and inclusive recovery. Chair Powell, I look forward to your testimony this afternoon, and I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Well, thank you, Madam Chair. Chairman Powell, welcome back, albeit virtually. There's a great deal of uncertainty right now. What I am certain of is this: you have earned and deserved another term as chair of the Federal Reserve. You have proven to be a steady hand throughout this pandemic, our ongoing recovery, and you've defended the independence of the Fed. Thank you for your service. Thank you for your leadership. Now, we're going to spend the next 3 hours telling you everything you've done wrong, but you do deserve another term. In all seriousness, though, the Federal Reserve needs to be laser focused on our economic recovery. Instead, I'm seeing more headlines about the Fed's actions to address issues like climate change, while a noble cause, but this should be something originating in Congress, not in the central bank. As far as our economic rebound, we're facing some very serious challenges. Put simply, America has a jobs problem. Not long ago, there weren't enough jobs, but that's not the case this time. There are more than 9 million jobs waiting to be filled. Employers across the country are competing for labor, offering signing bonuses, back to work incentives, and higher wages. The National Federation of Independent Businesses released a survey yesterday reporting that 63% of small businesses have already increased wages to attract workers. We should be seeing a boom and return to work, but we're not. Throughout the spring, job numbers continue to fall short of expectations. Yes, the June report showed 850,000 jobs were added, but this misses the larger picture. The labor force participation rate remained unchanged at 61.6%. The number of long-term unemployed Americans have increased by 233,000, and companies continue to struggle to hire enough workers to meet their business needs. We need a plan to get people back to work, not just in the short term, but in the long term. That's what we should be focused on. I wish my Democrat colleagues felt the same way. Instead, they want to continue the spending binge that they're all about, on a laundry list of progressive ideas that have no hope of bipartisan support and have nothing to do with getting Americans back to work. The $2 trillion COVID package that was passed in March wasn't enough spending for them. So now we're hearing that Senate Democrats want as much as $3.5 trillion in new spending and increased taxes on businesses of all sizes. And on top of that, another trillion for hard infrastructure. None of this is sustainable. This spend first and ask questions later approach to fixing our economy will not work. Our economy simply cannot handle this level of spending. Long term, it will lead to sluggish growth, persistent unemployment, and a declining standard of living. Simply put, the Democrats are addicted to spending. Taxpayers, families, and business owners will bear the consequences. We should instead focus on creating the kind of real economic growth that is proven to be enduring and stable. That means a focus on regulatory relief, sound money, and a competitive tax system. This will deliver the kind of broad prosperity that defines our uniquely American system of free enterprise. To have a recovery that works for all Americans, we need to get Americans back to work. Madam Chair, thank you for holding this hearing. I would like to welcome our newest Republican member of the committee, a gentleman who is not new to Congress, but is a returning member of Congress and has been on leave when he left the Senate, the House Banking Committee. He's been on leave with the Rules Committee, and under our rules, he's gets to come back to his home base that he left years ago. And so we're grateful to have Pete Sessions back with us on this committee and in this room, and look forward to his service. Like we have so many great Texans on this committee, we're glad to have him on the committee as well. And with that, Madam Chair, I yield back.
Thank you very much, and welcome back, Pete Sessions. We're glad to have you back. At this time, I will recognize the gentleman from Connecticut, Mr. Himes, for 1 minute.
Thank you, Madam Chairwoman, and Chair Powell. Welcome once again before the committee. We are going to be hanging on your every word today with all that's going on out there. Mr. Chairman, 3 weeks ago, I had the privilege of being appointed by the Speaker to chair the Select Committee on Economic Disparity and Fairness and Growth. I have reason to believe that the ranking member may also come from this committee, and membership will come from this committee as well. Mr. Chair, I was enormously gratified to see a statement you made in May to the National Community Reinvestment Coalition when you said, and I quote you here, "The Fed is focused on these long-standing disparities because they weigh on the productive capacity of our economy. We will only reach our full potential when everyone can contribute to and share in the benefits of our prosperity." Mr. Chair, as you know, we see economic disparities in this country that we've never seen before. And you made the case that apart from the moral issue, there is a profound economic reason to address those disparities in as much as it is damaging our productive capacity. The committee looks forward to working with you on this issue in a bipartisan way. And I really thank you for highlighting that. And we'll ask you to continue to reflect on what the Fed can do to address those sorts of disparities. And with that, I look forward to your testimony and yield back.
Thank you very much. I now recognize the gentleman from Kentucky, Mr. Barr, for 1 minute.
Thank you, Madam Chair, and Chairman Powell. Welcome back to the committee. I join the ranking member's view that you have earned another term. The CPI data released yesterday, though, does paint a grim picture. Inflation is accelerating at the fastest pace in 13 years. The 5.4% year-over-year increase is the highest since August 2008. Core CPI surged to 4.5%, the sharpest increase in almost 30 years, and 47% of small businesses raised average selling prices in June, the highest share since 1981. Let's be clear, inflation is a tax hike on everyday consumers and small businesses. While accommodative monetary policy, supply chain bottlenecks, and increased consumer demand associated with reopening the economy are contributing to the rise in prices, reckless government spending and the prolonged policy to pay people not to work are exacerbating the problem. The Biden administration's desire to tax and spend compromises any hope we have that this inflation is transitory and paints us into a corner of lasting inflation that will decrease the purchasing power of American consumers and small businesses. I look forward to today's testimony about the real and immediate risk of higher inflation. I yield back.
Thank you very much. I would like to take this moment to welcome our distinguished witness for today, the Honorable Jerome Powell, the Chair of the Board of Governors of the Federal Reserve System. Without objection, your written statement will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I would ask you to be mindful of the timer and quickly wrap up your testimony if you hear the chime. Chair Powell, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, and other members of the committee. I'm pleased to present the Federal Reserve's semi-annual monetary policy report. At the Fed, we're strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. We pursue these goals based solely on data and objective analysis, and we are committed to doing so in a clear and transparent manner. Today, I will review the current economic situation before turning to monetary policy. Over the first half of 2021, ongoing vaccinations have led to a reopening of the economy and strong economic growth, supported by accommodative monetary and fiscal policy. Real gross domestic product this year appears to be on track to post its fastest increase in decades. Household spending is rising at an especially rapid pace, boosted by strong fiscal support, accommodative financial conditions, and the reopening of the economy. Housing demand remains very strong, and overall business investment is increasing at a solid pace. As described in our monetary policy report, supply constraints have been restraining activity in some industries, most notably in the motor vehicle industry, where the worldwide shortage of semiconductors has sharply curtailed production so far this year. Conditions in the labor market have continued to improve, but there is still a long way to go. Labor demand appears to be very strong. Job openings are at a record high, hiring is robust, and many workers are leaving their current jobs to search for better ones. Indeed, employers added 1.7 million workers from April through June. However, the unemployment rate remained elevated in June at 5.9%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the last year. Job gains should be strong in coming months as public health conditions continue to improve and as some of the other pandemic-related factors currently weighing them down diminish. As discussed in the monetary policy report, the pandemic-induced declines in employment last year were largest for workers with lower wages and for African Americans and Hispanics. Despite substantial improvements for all racial and ethnic groups, the hardest hit groups still have the most ground left to regain. Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price increases from last spring drop out of the 12-month calculation. In addition, strong demand in sectors where production bottlenecks or other supply constraints have limited production has led to especially rapid price increases for some goods and services, which should partially reverse as the effects of the bottlenecks unwind. Prices for services that were hard hit by the pandemic have also jumped in recent months as demand for these services has surged with the reopening of the economy. To avoid sustained periods of unusually low or high inflation, the FOMC monetary policy framework seeks longer-term inflation expectations that are well anchored at 2%, the committee's longer-run inflation objective. Measures of longer-term inflation expectations have moved up from their pandemic lows and are in a range that is broadly consistent with the FOMC's longer-run inflation goal. Two boxes in the July monetary policy report discuss recent developments in inflation and inflation expectations. Sustainably achieving maximum employment and price stability depends on a stable financial system, and we continue to monitor vulnerabilities here. While asset valuations have generally risen with improving fundamentals as well as increased investor risk appetite, household balance sheets are on average quite strong. Business leverage has been declining from high levels, and the institutions at the core of the financial system remain resilient. Turning to monetary policy, at our June meeting, the FOMC kept the federal funds rate near zero and maintained the pace of our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. We continue to expect that it will be appropriate to maintain the current target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As the committee reiterated in our June policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. As always, in assessing the appropriate stance of policy, we will continue to monitor the implications of incoming information for the economic outlook and would be prepared to adjust the stance of monetary policy as appropriate if we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal. In addition, we're continuing to increase our holdings of Treasury securities and agency MBS, at least at their current pace, until substantial further progress has been made toward our maximum employment and price stability goals. These purchases have materially eased financial conditions and are providing substantial support for the economy. At our June meeting, the committee discussed the economy's progress toward our goals since we adopted our asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, Participants expect that progress will continue, and we will continue these discussions in coming meetings. As we've said, we'll provide advance notice before announcing any decision to make changes to our purchases. To wrap up, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. The resumption of our Fed Listens initiative will further strengthen our ongoing efforts to learn from a broad range of groups about how they are recovering from the economic hardships brought on by the pandemic. We at the Federal Reserve will do everything we can to support the recovery and foster progress toward our goals of maximum employment and stable prices. Thank you. I will look forward to our discussion.
Thank you very much, Chairman Powell. And I'd like to clarify that the end time for this hearing is 3 o'clock Pacific time and 12 p.m. Eastern time. So thank you very much. And at this time, I would now like to recognize myself for 5 minutes for questions. Chair Powell, I want to understand some of the data behind the recent inflation figures, specifically as it relates to housing and home prices. According to the Monetary Policy Report we are discussing today, quote, new construction, home sales, and residential improvements have all been well above pre-pandemic levels, and demand has outpaced supply as construction has been limited by material shortages and sales have been constrained by low inventories, unquote. So demand for housing clearly outweighs the supply of housing. Chair Powell, you said that this is a problem for first-time home buyers for sure. Can you elaborate on what you meant by that? Chair Powell, will you unmute?
I'm sorry, Madam Chair. So housing prices are moving up across the country at a high rate. And I suppose the good news is that this is not driven by the kind of reckless, irresponsible lending that led to the housing bubble, that led to the last financial crisis. Those kinds of things are not happening, at least so far. Nonetheless, housing prices are moving up. And of course, that makes it more difficult for entry-level buyers to get into the housing market. So that is a concern. I will also point out, though, that a number of things are driving up housing prices. Certainly, low rates are part of that. There are also changes in preference. People have wanted to move out of cities because of COVID into surrounding areas. So single family housing demand has been quite high. In addition, prices have been driven up by material shortages and things like that, which we would hope would be alleviated.
Okay, so Chairman Powell, a lack of supply and constraints around housing stock are a factor in the recent increase in housing costs. If the Fed were to raise interest rates, what do you project the impact would be on addressing housing supply challenges?
Well, it wouldn't have any effect on the supply side, as I think you're suggesting. There are limitations around the availability of some raw materials and of labor and of zoning and things like that, and nothing we can do can really affect that. It is true that interest rates are one factor that's supporting demand, but we really can't do much about the supply side.
Conversely, do you expect that increasing housing supply would help alleviate inflation?
I think housing, sure. I do think that more housing supply, if demand were to remain constant, would certainly imply that prices would stop going up as much as they have been.
The Great Recession was long, slow, and inequitable, in part because fiscal support provided by Congress was insufficient. And we left too much up to the Fed to stimulate the economy through low interest rates. I believe strongly that we cannot repeat that mistake. And as I look around at what is causing surging prices, I see a lot of places where more investment will help with long-term economic growth, especially more housing. Congress and the Biden administration have a job to do right now. It is for this reason I'm reintroducing my Housing is Infrastructure Act. this week to ensure that Congress finally makes long overdue investments in the housing market. This bill would provide a historic investment of more than $600 billion to ensure that affordable housing is available all across the country. And so, as you know, I'm focused very much on housing, and I understand that there's a great need for affordable housing. As you know, homelessness is just increasing all over this country, and some cities have given up on even trying to control the camps that are popping up on sidewalks and under bridges. And so how important do you think housing is, investment in housing is to this economy?
Well, the housing industry is a big one, and the problem of affordable housing is a big one too, albeit it's one outside of the largely outside of the ambit of the Fed's responsibilities, but certainly a very important issue. And I think as you point out, the rise in homelessness in the face of a very strong recovery is actually evidence of the unevenness of the recovery. So, which is something we try to keep in mind as well.
Well, thank you very much. I now call on the ranking member for 5 minutes for questions.
Chair Powell.
Mr. McHenry.
Chair Powell, thank you for being back. We have a lot of debate about monetary policy, but fiscal policy is also an important discussion. Chair Powell, when Congress, and I recognize, Chair Powell, you have say over monetary policy, but not fiscal policy. This is the responsibility of Congress. But Chair Powell, when Congress enacts new spending, does the Fed incorporate that new spending into its economic projections?
Yes, we do. Of course, we don't, as you know, we don't comment on or try in any way to play a role in fiscal policy, in particular fiscal policies. But yes, we take it as an external factor that we would factor into our models and into our assessment of the economy. Okay,
so that spending impacts the course of Fed's decision making, and the Fed will follow, in essence, right? You have no say over it, but you will incorporate that into your decision making. Will adding another $4.5 trillion in new spending impact the Fed's decision making?
So I should be clear, it's one of many factors that we consider. And, so our focus is on maximum employment and price stability. So we would tend to look, one thing would be, you would want to know how much of it's paid for and that kind of thing, but sort of the net deficit spending would enter into anybody's projections really of the economy and ultimately into projections of the labor market and of inflation over time. It's hard to say exactly how without knowing a lot of the details, because it also depends, it matters what money is spent on and over what period of time and that sort of thing.
Sure. So the spend rate matters, but fiscal policy, both tax and spend policy, impacts the Fed's decision making. So for those in Congress that are saying that irresponsible spending won't impact the Fed's decision making and won't impact our economy long term, it certainly is not in keeping with how these decisions are made. So I want to switch subjects a little bit. Chair Powell, as you know, there's been a great interest in central bank digital currencies. Many countries, like China in particular, are focused on establishing a CBDC. You indicated this earlier this year, the Fed would study and issue a white paper on the subject. What is the status of that report?
We expect to publish a report around, could be early September or plus or minus, right in that time frame. And the status of it is we're working hard on it right now. But let me tell you what it is really. We're going to address digital payments broadly. So that means stable coins, it means crypto assets, it means a CBDC. That whole group of issues and payment mechanisms, which we think are really at a critical point in terms of the appropriate regulation, and in the case of a CBDC, a central bank digital currency, laying out really questions for the public to respond to about what good it can do, what the costs and benefits of it would be. We want to begin really a major public consultation across many different groups, including Congress, of course, on a CBDC and also on stablecoins and crypto.
But so there are certainly advantages to a central bank digital currency or a faster payment system, but there are certainly risks. That's the case, right? This is not a riskless proposition. It's a pretty bold proposition for the Federal Reserve, is it not?
Yes, and we'll lay out the possible potential benefits. We'll put those out on paper, and also the potential risks that are undertaken. And I think those have been written up in many forums around the world. And I think both are real. And, it really depends. A lot depends on the U.S. institutional context and on why we would need a central bank digital currency and how you weigh those costs and benefits. So that's really the nature of the exercise.
And so stable coins certainly have some advantages in terms of a faster payment system and have some of the attributes of CBDC, but there are some risks with stable coins right now. Are there not? Are there concerns you have about stable coins?
Yeah, I think the issue, stable coins are a lot like money market funds or bank deposits or a narrow bank, depending on the terms of them, that kind of thing, but without the regulation. And I think we have a tradition in this country where the public's money is held in what is supposed to be a very safe asset. We have a pretty strong regulatory framework around bank deposits, for example, or money market funds. That doesn't exist really for stablecoins. And if they're going to be a significant part of the payments universe, which we don't think crypto assets will be, but stablecoins might be, then we need an appropriate regulatory framework, which frankly we don't have.
Thank you.
Thank you very much. Clarification. This hearing will end 3 p.m. Eastern time, 12 p.m. Pacific time. Why didn't somebody say something?
Well, that's a relief for all of us.
I'm relieved, Madam Chair.
Okay.
Well, yeah, we
Yes.
don't like interrupting our chairwoman. That's why we knew you would figure it out.
Excuse me, the gentlewoman from New York. Thank you, Ms. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Well, thank you for that correction.
You're
Chair
welcome.
Chair Powell, it's very good to see you again. Last month, when you testified before the Select Subcommittee on Coronavirus and the Crisis, you and I discussed the current economic recovery, and I expressed concern, along with other members, about prematurely cutting off this recovery by raising interest rates too soon. I want to touch on a related topic today, and that's the Fed's asset purchases. As you know, the Fed is currently supporting the economy by purchasing $120 billion a month in treasuries and mortgage securities, and the Fed has said that it will continue these purchases until, quote, substantial further progress has been made toward the committee's maximum employment and price stability goals, end quote. The minutes from last month's Fed's meeting stated that the Fed is continuing its asset purchases because participants generally did not believe that the goal of, quote, substantial further progress has been made yet. And I agree. I think it's far too early for the Fed to start tapering its asset purchases and pulling back on its support for the economy. So, Chairman Powell, would you please elaborate on what you believe, quote, substantial further progress, end quote, looks like? What do you need to see happen before you will support tapering the Fed's asset purchases?
So we'll know. I would say this: we didn't try to write down a particular set of numbers that would capture what we mean by that, and it would have been complicated and not particularly worthwhile. So we thought. So we said substantial further progress, which is similar to what we did during the recovery of the global financial crisis years ago. We had a similar kind of set of words for when we would taper asset purchases. So the thing is, it's very difficult to be precise about it because with maximum employment, there are no 3 or 4 or 5 or 6 metrics that you could point to. It really is a very broad range of things, including wages, unemployment, levels of employment, participation, all those things. So we just said substantial further progress. And we also said that we would provide advance notice, well in advance of actually tapering, so that understanding that this is somewhat of a discretionary test, and that we don't want to surprise markets or the public. So we will provide lots of notice as we go forward on that. And by the way, we have another FOMC meeting in a couple of weeks from today, and we'll have another round of discussions on this very topic.
Great, thank you. Chair Powell, in May, President Biden took action through an executive order to address the serious threat that the climate crisis poses to our economy. And we are seeing numerous examples of that changing climate and extreme weather events that result from this threat. We saw extreme heat across the Pacific Northwest, which will have cascading effects on the U.S. economy. And part of that executive order was tasking Secretary Yellen with assessing climate-related financial risks through FSOC, of which the Fed is a member. And I know the Fed presented on climate risk during the first FSOC meeting of this year. Can you provide us with an update on the Fed's current work with FSOC on this topic and the Fed's broader work to address climate change in our financial system, particularly at these risks, how these risks can impact our broader economy through supply chain disruptions or disruptions to massive industries such as agriculture?
Sure, I'd be glad to. So the Fed's work on climate change really exists as part of our pre-existing mandates for supervising financial institutions and for the overall stability of the financial system. So as far as individual financial institutions are concerned, as supervisors, we want them to be aware of and capable of managing and understanding all of the risks that they run, including the risks to their business activities and business model from climate change. So we're in the beginning stages of working up a program that will engage with the financial institutions and make sure that that happens. On financial system more broadly, we have an overlapping effort that looks carefully at the broader financial system and asks how will climate change affect financial markets and other financial institutions that are not banks, for example, insurance companies and many others like that, asset managers. And so those are really two efforts that we're working on, and that's what we reported on to the FSOC.
Time has expired. Thank you very much. I yield back. Thank you.
The gentlewoman from Missouri, Ms. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman, and Chairman Powell, thank you for being here with us again today. You and I have discussed at length my very grave concerns with higher inflation and the increased costs that consumers and businesses are experiencing, today. In February, you appeared before this committee and reiterated that the price spikes are only temporary. And that they will decrease in time and inflation will move towards your goal of 2%. I can tell you that the families and businesses that I represent in Missouri's 2nd Congressional District aren't feeling that these price spikes are very temporary. I am concerned with the most recent Consumer Price Index data showing price increases that are much higher than expectations. Housing costs are, as we've discussed here, are skyrocketing. Food costs are higher, electricity and gas prices are up. Even travel and hospitality costs have seen a great increase. I understand that some of these increases are due to supply chain disruptions and labor shortages, but to have prices across the board consistently higher than they were forecasted to be is deeply troubling as we look toward a strong economic growth for the rest of the year and beyond as we pull out of this pandemic. Chairman Powell, is it the Fed's policy or the Biden administration's policy that is, that's surrounded with massive spending that is causing consumer prices to skyrocket?
I can't really address that. I can tell you why I think we're having this inflation that we're having now. So what's really happening is, First of all, you're right. The incoming inflation data have been higher than expected and hoped for, but they're actually still consistent with what we've been talking about. The very high inflation readings are coming from a small group of goods and services that are directly tied to the reopening of the economy. It's new cars, used cars, rental cars, hotel rooms, airplane tickets, things that we understand had a connection.
With all due respect, Chairman Powell, I mean, it's housing, it's appliances, it's food prices, it's electricity, it's gas. Tell me, to what extent is the Federal Reserve willing to see consumer prices increase before intervention is necessary?
Well, so we are monitoring the situation very carefully, and we are committed to price stability. And if we were to see that inflation were remaining high and remaining materially higher above our target for a period of time, and that it was threatening to uproot inflation expectations and create a risk of a longer period of inflation, then we would absolutely change our policy as appropriate.
Well, unemployment is still well above the 3.5% figure it reached prior to the pandemic, and the labor force participation rate remains lower than in February of 2020. Now, a lot of that is because the administration is still, frankly, paying people not to work, and while job openings remain high at 9.2 million. In the FOMC minutes from June, some participants believed that the unemployment rate of 3.5% that the previous administration achieved is not feasible. Chairman Powell, with 9.2 million job openings and many employers raising wages and offering hiring bonuses, et cetera, what is causing some members of the FOMC to believe a 3.5% unemployment rate is not achievable?
I don't know that anyone said that. I didn't hear anyone say that 3.5% unemployment
it's
is.
in the minutes. It's in
No,
the
it's
minutes
not.
from June.
No, it's not. It must be something else. It must be something that says, you might say that about labor force participation, for example, or employment to population. But I don't think, I didn't hear anybody say that we couldn't get back to 3.5% unemployment. In any case, I don't believe that. Let me just say that. I don't believe that. I think it's a long road back. It took us it took us 8 years of an expansion to get to 3.5%. But I think there's every reason to think that we can get back to that level.
With a vaccine readily available in small businesses with unfilled positions, what do you believe is causing the unemployment rate to remain steadily above 3.5%?
Well, so I think you're right that the demand for labor is very, very high, all-time record job openings, and there are also significant numbers of unemployed people. The market doesn't seem to clear, and I think some factors are weighing on labor supply, people going back to work. We think that those factors, though, such as school reopenings and perhaps also unemployment insurance, we think that those things will pass, and we do think that as a result, there'll be very strong job creation.
Thank you, Chairman Powell. My time's expired and I yield back.
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Speaker, and welcome back, Chairman Powell. As you know, the Biden administration recently issued an executive order promoting competition in the American economy and encouraging the Attorney General, in consultation with the primary federal banking agencies, to update existing guidelines on bank mergers to provide more robust scrutiny on these transactions. And I support this executive order, considering the impact that bank consolidation can have on communities of color. Now, compliance with the Community Reinvestment Act is an important measure that the DOJ and the feds consider during the bank merger review process. And as you know, I've publicly supported the Fed's direction in modernizing CRA regulations so that things like the bank merger review process can adequately reflect the economic needs of today. So can you please explain how the Fed plans to coordinate with the DOJ in light of the bank merger executive order? And will the Fed's CRA reform efforts and the DOJ's bank merger updates happen in silos or in tandem?
Thank you. So we actually, we coordinate pretty closely with the Department of Justice over the years. on bank antitrust standards. We each look at each merger, and so we understand each other. And we would look forward to the extent justice, I think, under the executive order is encouraged to take a fresh look at bank merger standards. We would, of course, closely coordinate and try to understand what's going on. We haven't made any decision to change our merger standards, but we would certainly monitor that carefully and act appropriately. I can't presume to know what will happen out of this, but it's a process that we'll go through in coordination with justice.
Well, hopefully, the coordination is important, I believe, to act in tandem so that there's not several different CRA rules and regulations that comes out, as we've talked about with the OCC and others. So I appreciate the Fed making sure that there's some continuity in that regards and working in tandem. So also, the pandemic has really disrupted, I believe, the housing market, as it was indicated by the chairwoman. And I look at the disproportionate number of homeowners, particularly in my district, of Black and brown homeowners relative to New York City at large. Now, in the pandemic's early days, the Fed rightfully intervened and purchased mortgage-backed securities in the billions, which helped keep the interest rates low, I understand. However, we've also experienced a rise now in housing prices, which some attribute to the Fed's asset purchases. Now, although others cite supply chain challenges. So I understand there's a debate at the Fed as to how quickly it should taper its MBS purchases. But what are some of the economic factors you are considering as you weigh both sides of this argument?
So housing prices are going up because of both demand and supply reasons, and you touched on them, Congressman. On the supply side, it is prices of raw materials and lack of labor, labor costs, zoning difficulties, all those things. So it's not just a demand story. On the demand side, rates are definitely low. Interest rates are certainly making mortgages cheaper and therefore supporting prices in housing. That's certainly a factor. There are other factors too. Changing preferences. People are household balance sheets are very strong right now because people were kind of forced to save because they couldn't go on trips, they couldn't go to restaurants for a year. So there are big amounts of savings on people's balance sheets. So all of that goes into demand for housing. Sorry, then your question on that was what?
So what are some of the economic factors that you are considering, in that argument? There's both.
Oh, on mortgage-backed securities. So on mortgage-backed securities in particular, so interest rates, our low interest rates and treasury purchases and MBS all go into creating a low interest rate environment and go into mortgage rates. Mortgage-backed securities purchases really work a lot like treasury purchases. They aren't especially important in what's happening with housing prices. They are nonetheless, they clearly are a factor among factors. So this is one of the things that we'll be considering as we go through this process of evaluating when to taper and in what form, what will be the composition of asset purchases going forward. Those are all issues that we'll be discussing at this next meeting in a couple of weeks.
Thank you, Mike. We're back.
Thank you very much. The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Well, good afternoon, Chairman Powell. Appreciate you being here and certainly appreciate you answering our questions. I know this remains a tricky time in the recovery, and our collective understanding about the Fed's effort and reasoning here is very important. I have a long preamble that I hope ends in a question, so take a little bit of a journey with me. First and foremost, I want you to know I'm in no way besmirching the good work the Fed has done over the last year. The extraordinary economic cessation necessitated extreme action, and you took that action with vigor. I'm thankful for that, and my view on that is unchanged. Second, my question is not meant to imply that you need a hawkish stance. I think we can all agree that monetary policy is very accommodative at present, perhaps at the furthest end of the accommodative side of the spectrum as is conceivable. I'm questioning merely the degree of accommodative stance, not asking to return to a restrictive side of the spectrum. Third, I have on many occasions endorsed your new symmetrical approach to inflation target. I believe this is exactly the right answer. My question today is not tied to recent inflation numbers, nor would I prognosticate about whether it's transitory or not, whether it's a monetary phenomenon, a demand phenomenon, nor the magnitude of what it may reach. But here's the crux of my question. I think there's a lot of data out in the economy showing that it is awash in liquidity. A panoply of statistics indicate the tremendous / unprecedented increase in liquidity over recent years. In recent weeks alone, you've raised the reverse repo rate to 0.05%, and the uptake on that product has been tremendous, which in and of itself is a reaction to money markets being overwhelmed with liquidity, which in and of itself is a reaction to bank deposits being overwhelmed. Yet the ultra accommodative stance by the Fed continues. And when asked about this over the last few months, and I think you indicated this in your earlier testimony, I've heard you say that there needs necessary further healing in the labor market for that ultra accommodative stance to change. I agree with this. There's much room to go. But what I don't understand about that answer is that a cornucopia of evidence suggests that challenges in the labor market are not related to monetary policy and frankly aren't susceptible to monetary policy's aid. The Fed, and no indictment on the Fed, monetary policy writ large isn't the right vehicle and doesn't have the right tools to resolve skills mismatch, to resolve no work incentive balancing, and to resolve geographic mismatch. As you said earlier, there isn't a lack of demand in the jobs market. So I guess getting to the specifics of my question, I believe the Fed is distorting significantly the financial economy for very little, if any, maybe marginal impact on the real economy. To couch specifically inside your mandate, are you jeopardizing long-term full employment and price stability by virtue of extreme monetary policy and picking up very little short-term benefit in full employment? I wondered if you might talk about your reasoning and your colleagues' reasoning for remaining and retaining that extreme accommodative stance and using labor market as justification, despite significant evidence indicating that the labor market needs are not monetary policy related. I think you're muted. Sorry.
I did it again. I would just say this. So policy is highly accommodative. That is correct. We're a long way from full employment. We have, as you know, 5.9% unemployment, and the true number is actually substantially above that. So we've got a ways to go. We see everything that you see, but I guess what we see is that our test for tapering asset purchases is an appropriate one, and we're making progress toward that. So we are, in fact, considering.
I guess just to needle into that for a second, we are making progress. I do not believe that progress is a result of that monthly asset purchases. And I think I've seen significant evidence that indicates that monetary policy isn't making an impact on that. Other factors are making an impact on that. And I wonder whether the financial distortion that is occurring, and is by its nature monetary policy, isn't causing long-term problems for very little short-term gain.
Yeah, no, I guess that's where I would differ is I do think monetary policy is supporting demand and demand broadly in the economy and the recovery of the weak sectors and all of that. So it's still appropriate that monetary policy be accommodative, highly accommodative.
You believe that the difference between 60 billion and 120 billion, or 0 billion and purchasing 120 billion, is a material impact on the point at which we will reach full employment? Question mark.
I mean, it's hard to say that with any specificity, but yes, I think our overall policy stance is appropriate. And as you know, we are very much in the process of walking down the road and asking those very questions. And first on tapering, but I also think it's, we're a good ways away from maximum employment. And one of the conditions for lifting interest rates is that we are at labor market conditions that are comparable, in the range of maximum employment.
Thank you very much. The gentleman's time has expired. The gentleman from Massachusetts, Mr. Lynch, is now recognized for 5 minutes. Mr. Lynch?
You hear me?
Now I can.
Okay. Thank you, Madam Chair. And Chairman Powell, thank you so much for your willingness to help the committee with its work. So I was very pleased to hear in your opening remarks that the Fed plans an open dialogue with the public and with stakeholders regarding CBDCs, and as well as cryptocurrency generally. And I think that's much needed. And I'm very proud of the fact that the Boston Fed, under the leadership of Eric Rosengren, has been working with MIT in their cryptocurrency lab on working on this digital dollar for the United States and for the Fed. I am a little bit worried about the pace, though. We see, I think there's 86 separate central banks that are already engaged in this. Do we risk sacrificing the primacy and the reserve currency status by I think some would argue slowness in response to this? And does this dialogue that you envision stretch out the timeline for adopting, say, a digital dollar for the U.S.? Does it delay that considerably?
I would agree. No, actually, I think the opposite. I think this is the beginning of I would think accelerating that decision process. We have a lot of work left to do on the technical side and on the policy side, but a critical part of it is just the public consultation. But on reserve currency, the U.S. is the reserve currency. There really isn't a good competitor out there, because all the things you need to be the reserve currency, really, the United States has it. We're not in danger of losing it. Certainly not to China, which doesn't have an open capital account and that kind of thing. It's the kind of status that, as you well know, lasts for many, many years. So I'm not concerned about. I'm really concerned about getting this right. It does carry risks. It does have benefits. It's quite specific to the institutional context of each country, and I want to get it right. We are the reserve currency. You know, we have first mover advantage by virtue of that. So I think it's way more important to get it right than it is to do it fast.
Yeah, that's fair enough. Let me ask you another question that's a little off topic, but recently China has taken somewhat hostile action against IPOs being launched in the United States. Didi, the ride-hailing business in China, is one of the recent examples. The Chinese government has offered several different reasons for wanting these Chinese companies to register in China versus in the U.S. They've given, like I say, they've given various reasons for that, the security of data being one of them. I was wondering if you had, this is probably a better question for Mr. Gensler, but I was wondering if you had thoughts on that, about what the ultimate reasons were for China taking that action.
Yeah, I would pass that to my friend Gary Gensler. I think it's right over his home plate there. So for him, I mean, I'll just say it's important that we have, open capital accounts and open capital markets and global rules that we all abide by. And but I don't know how to address that one, because it's really for the SEC.
Okay, and lastly, do you think that I have 1 minute left? Do you think that maybe more swift action on a digital currency for the Fed, would that have a calming effect on the variety and the number of cryptocurrencies and stable coins that we see coming out? Wouldn't that be a more viable and reliable alternative than having all of these hundreds and perhaps 1,000 different cryptocurrencies emerging?
I think that may be the case, and I think that's one of the arguments that are offered in favor of a digital currency. That particularly you wouldn't need stable coins, you wouldn't need cryptocurrencies if you had a digital U.S. currency. I think that's one of the stronger arguments in its favor.
That's great. Madam Chair, I yield back. Thank you.
Thank you very much. The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell. I want to pick up where my friend, Mr. Hollingsworth, left off, and want to focus specifically on the unemployment piece. And frankly, when I talk to my businesses back home, where I'm currently seated, the two biggest issues that they face, in particular small businesses, employment, not being able to get people back to work, and inflation. So a timely hearing right in your wheelhouse. So first, with respect to unemployment, in the monetary policy report, you cite several factors that are keeping people out of the workforce, most of which, or all of them, are virus related. So early retirements, caregiving responsibilities, fear of COVID, and expanded unemployment benefits. Using those factors, which you cited in the monetary policy report as responsible for diminished employment, would you agree that the zero interest rate posture is not a primary driver of getting people back into the workforce today? And maybe said differently, do you think if you lowered us to negative interest rates that would materially change the unemployment rate?
Let me try to answer that this way. I would agree with you that the most important thing, it would be very important if we were to see a significant increase, as we expect we will see, in labor supply, just showing up in the form of better matching in the labor market. There are all these open jobs, and there are many unemployed people, but they just don't seem to be matching up. And maybe there's a speed limit on that. But in any case, as those factors wane, we should see more of that, and that's probably of first order importance at this time.
Okay, so not the rate of interest, and I think that's important because the commitment is to keep rates at zero until we get back to full employment. But we know what's happening is it's inflating asset bubbles. It's pushing people further and further out on the risk curve. I would argue it's creating systemic risk in a variety of markets. And so I would just encourage you all to consider that. And now moving on to the inflation bit, the common refrain from the Fed has been that inflation is transitory. There's nothing to worry about. And you will maintain rates at zero until inflation is moderately above 2% for, quote, some time. And you've said that a handful of times here. Well, we're looking at 4 consecutive months now, including the previous month at over 5%. So how long is, quote, some time? And what factors are you looking at that will tell you whether this is transitory or something more systemic?
Okay, let me say first on maximum employment, even after this expected wave of supply comes, it's likely that we'll still be short of maximum employment. And at that time, support for demand will be appropriate. And so that's why we wouldn't see that it's time to raise interest rates now, because we think it'll take some time even after this to get there. So getting to your inflation question.
Which is basically how long is some time? Because it keeps being used. We'll keep it lower some time.
So that will be the answer really is it depends. You're really asking about that part of the guidance and how do we think about that? Right now, of course, inflation is not moderately above 2%. It's well above 2%. And it's nothing like moderately. So the question will be, and this will be a question for the committee, how to interpret the guidance. The question will be, where does this leave us in 6 months or so when inflation, as we expect, does move down? How will that part of the guidance work? And it will depend on the path of the economy. It really will. It may be that we'll look back and see this having been met. It may be that we won't, but we're not going to address that right now. But it's a good question.
Okay, thank you. I want to switch to stable coins and pick up where Mr. McHenry left off, specifically on Tether. So in recent months, there's been increased scrutiny of the stablecoin Tether due to concerns regarding the assets backing the coin, particularly the amount backed by commercial paper as opposed to US dollars, which is what they originally said. President Rosengren said that Tether does create a challenge and that we need to take seriously what happens when people run from these instruments very quickly. Do you share these concerns, and how is that the sort of thing that you'll be looking at and providing guidance on with the white paper?
Yes, absolutely. Yes. I mean, the commercial paper, are short-term overnight obligations of companies, and most of the time they're investment grade. Most of the time they're very liquid. It's all good. But in both of the last two financial, during the acute phase of the crisis, the market just disappears, and that's when people will want their money. So, it's very simple. These are economic activities that are very similar to bank deposits and money market funds, and they need to be regulated in comparable ways. That's how I see it.
I yield.
Thank you. The gentleman's time has expired. The gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Chairman Waters, and it's definitely Jersey.
Yes.
And thank you, Chairman Powell, for being here today. The SALT deduction cap jammed through Congress in the 2017 tax hike bill raised taxes for a majority of the families in my district. These are my community's teachers and first responders, small business owners, young people trying to start a family, all groups who are struggling in this pandemic and now trying to get back on their feet. When you were before this committee earlier this year with Treasury Secretary Yellen, the secretary said that the SALT cap led to disparate treatment, quote, and that she would work with me to ensure that the inequities caused by the cap would be remedied. Chairman Powell, is increasing disposable income for households a crucial tool to stimulate the economy and ensure that our communities see the economic activity necessary to help small businesses come back from the pandemic? And do you think SALT's part of that solution, reinstating the SALT deduction?
So, we have really important jobs and powerful tools, but one of them is not fiscal policy. We don't really want to play a role on that. So I'd have to leave that with you.
Okay, well, I figured that'd be your answer, but I was going to ask it anyway. I'll turn to inflation, since obviously lots of questions today about that. Given the movements we are seeing in inflation across commodities, housing, and wages, should we be concerned about what happens to long-term interest rates once the Fed stops purchasing long-dated treasuries? And do you want long rates go up, and what will happen, do you believe, to the economy?
I wouldn't want to make a forecast. It's very hard to forecast long-term rates. If anybody had forecasted that we'd be able to borrow the amounts we've borrowed in the last 10 years, and that the federal funds rate would be at the 10-year treasury would be at 1.4%. No one would have forecast that. So it's really hard to say. There's tremendous demand for U.S. treasuries around the world. We are the safe asset. We are the reserve currency. And in any case, our role is to do maximum employment and price stability, and not fiscal policy.
Well, since the Fed is by far the largest buyer, you don't think that long-term rates will go up meaningfully when this occurs, when you stop?
Honestly, they may or may not. Markets work, as you know, work through expectations. So if markets foresee what we're going to do, then presumably, to some extent at least, what we're going to do should already be baked in. And it's very hard to predict markets' reactions to these things. But we're one of the reasons we're being so very transparent is that markets will incorporate the timing and the form of the taper that we're going to ultimately undertake here, because we will have sort of communicated it well in advance.
Thank you. Chairman, you said that one of the causes of inflation that consumers are experiencing is from supply bottlenecks. Some of these supply issues are being attributed to strains on supply chains because America's infrastructure is unable to take on the increased demand as our economy reopens. Would you agree that these bottlenecks would be alleviated in part through the robust direct investment in infrastructure, addressing our issues with roads and bridges, rails and ports, and that spending in long-term infrastructure projects would help in keeping inflation under control?
Again, I wouldn't want to be seen as supporting any particular bill or form of spending. I do think it's clear, though, that investments in infrastructure, in good infrastructure, can add to economic potential, provided the money is well spent. And but again, I don't want to. It's not appropriate for me to get involved in these discussions you're having.
I understand. I will espouse a bipartisan infrastructure package that the Problem Solvers Caucus in the House has been working with a bipartisan group in the Senate to try to get our investment in infrastructure into law and our economy back on track and set up for long-term success. I believe that will obviously help deal with some of the challenges we're facing and making these investments in roads and bridges and rail and energy infrastructure and broadband connectivity, all crucial to ensure America remains competitive on the global stage. Last question there. Are you concerned on the global stage? China spent about $3.7 trillion on infrastructure outside of the United States last year. Are you concerned at all about China's activity on this front and the spending they're doing outside the United States?
The issues of international economic relations are really with the Treasury Department and the State Department, not with us. So,
Well, I will yield back, Chairwoman, my last seconds here. Thank you so much, Chairman Powell, for being here today.
thank you.
Thank you very much, Mr. Gottheimer. And you forgot to add housing.
Sorry, I missed that in my litany. You're right, Chairwoman, from California.
The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry. And thank you, Chairman Powell, for being here today and for your leadership throughout the pandemic and now during our economic recovery. I'm going to go ahead and dive right in. Chair Powell, in November, the Fed took important steps to provide temporary relief for certain community banking organizations who experienced an unexpected and sharp increase in assets due to their participation in federal coronavirus response programs, such as the Paycheck Protection Program. That regulatory relief is in effect until December 31st of this year. And since that deadline was put into place, the Biden administration, along with House Democrats, passed a $2 trillion bill that will have an impact that extends past the end of the year. Do you believe that the end of year deadline is sufficient, and would you be open to extending the regulatory flexibility past that date?
I don't know, to be perfectly honest. I'd be happy to take a look at that and get back to you. I'm well aware of those programs and of the deadline, but I don't know. I don't have an informed view of whether they would need to be extended, but I will look into it.
In building off of that, I hear constantly as I visit with community banks back here in Middle Tennessee that regulatory compliance continues to be one of their top expenses or costs. So I think this brings up the broader question of if we should be looking into permanently raising the threshold for increased regulatory and reporting standards for community banking organizations. What are your thoughts on that, Chair Powell? Is that something you would support?
Again, I'd have to look at that. I will say that we are very well aware of the pressures that are added to community banks because of fixed regulatory costs. You need to be bigger with fixed costs, and we try hard not to be part of the problem. We see community banks under pressure. We see the number diminishing, and we have a whole subcommittee led here by Governor Bowman, a former banker, that is designed to stop that sort of thing from happening. But it's something we work on all the time.
Well, I just would encourage you to do that and look at those thresholds, because what I hear repeatedly, and as a former director of a small national bank, community bank here in my community, it appears that the dramatic increase in assets resulting from the fiscal stimulus and other measures may not be as transitory as we would have had first expected, and yet has increased the balance sheets of these banks dramatically. So I hope you will take a look at that. In June, the unemployment rate was 5.9%, a far cry from the 3.5% pre-pandemic. Labor force participation has not moved up from the low rates that have prevailed for much of the past year. In the monetary policy report you submitted the committee, you write that enhanced unemployment benefits have allowed workers to reduce the intensity of their job search. Chair Powell, do you believe that the most recent stimulus in the American Rescue Act is the reason for prolonged high unemployment rates, and has it in fact slowed down our economic recovery?
So there are a bunch of factors. There are 4 or 5. I think Mr. Gonzalez or somebody went through them, and it's very hard to untangle them. But it may be that on unemployment insurance, for example, it may be that enables people to look a little bit longer and try to find a better job, and in the long run, that'll be better for the economy. We're going to find out, though, because the enhanced unemployment insurance will be gone within 60 days. And in many states, it's gone already. So we'll be able to look at the data. And it's too early to say, by the way, we can't really see a difference between states that have and haven't eliminated that. So we're going to be able to see. My own suspicion is it's one of a number of factors, and it interacts with the other factors. And it'll be really hard to get a clear answer on exactly how important that is.
How could another $3.5 trillion, as proposed by Senate Budget Chair Sanders, further stifle our economic recovery?
That would seem to be a question for you, really. Again, I don't comment on fiscal policy, and I'll really leave that one with you if I could.
Switching gears a little in my remaining time, and I want to talk about the GSIB surcharge. Throughout the pandemic, our largest banks remained strong and stable due to high asset quality and robust capital and liquidity positions. I believe that over the years, the GSIB surcharge has worked as it was intended. And if the GSIBs do not maintain sufficient capital cushion to absorb losses, it could undermine our economy. It seems that I'm out of time, but would welcome your response to the record to the questions I'll submit.
Thank you. Happy to do
I
that.
yield back, Madam Chair.
Thank you very much. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, it is always good to be with you and to learn from what you are doing in your role. I too thank you for your steady leadership and stewardship over the course of your tenure, but maybe never so important as over the course of the last 18 months and moving forward. I also thank you for your recognition that this recovery has not been even. While we are enjoying a regrowth in our economy in really robust ways, I appreciate that you recognize it has not been even across all sectors. I wanted to start with to continue the conversation around inflation. And I say this as somebody who wants to be able to translate this to my constituents. I prefer plain English anytime we can. So I really appreciate your testimony around inflation. But if we talk about supply chain and the vulnerabilities that come in as a result during this economic reopening, the supply chain with manufactured goods, driving what is called transitory inflation. You cite in your own testimony the car industry. The biggest example may be the price of used cars, up 10% in April alone, and a number of factors, one with particular worldwide shortage of semiconductors slowing down the rate of new car manufacturing, therefore driving dealers to have fewer cars on the lot and buyers moving more toward pre-owned. All of these things inflationary. What are your thoughts and how can I explain this to my constituents around this level of inflation in these smaller groups of goods and services? What should we be watching? And if you could, again, in plain English, what's the Fed doing in terms of this temporary or what might be called transitory inflation?
Well, so we always have the issue, and central banks generally always have the issue of looking at price increases and asking whether they're really threatening inflation. By inflation, we mean year after year after year, prices go up. And if something is a one-time price increase, then you don't react to it with monetary policy because, you know, frankly, the way monetary policy works would be by slowing down the economy, slowing down the recovery, and therefore reducing inflationary pressure. So you wouldn't react to something that is likely to go away. So we have to look at this current situation where we have a number of categories of goods and services where inflation's moving up, as I mentioned, higher and than we expected, and a little bit more persistent than we had expected and hoped. But we look at them and we look at the story, and you know the story with you mentioned around used cars and new cars and rental cars is all kind of the same story. There's a shortage of semiconductors. There's also very high demand for various reasons. People are using less public transportation. They have money because they haven't been able to spend. And, you know, it's just a perfect storm of high demand and low supply. And it should pass unless we think there's going to be a multi-year, many-year shortage of used cars in the United States. We should look at this as temporary. And we very much think that it is. And so do all the forecasters I've seen think that these price increases for used cars and new cars they'll top out. And then in all likelihood, at some point in the future, and we can't say exactly when, they'll decline because supply will come back.
And do you think, you know, rather than, I appreciate that, those recommendations and what your actions are, is this a time when you see this kinds of transitory inflation of a need for greater public or private investment?
I think there's what investment does is it raises the potential growth rate of the country. and makes workers more productive and companies more productive and countries more productive. And that raises living standards. And so more of it is generally better. As long as it's money well invested, then it's worth looking seriously at any time.
I agree. And I would not call any of the things that we're trying to do irresponsible spending. I think you have demonstrated, and the economy is demonstrating, that our investment has been responsible spending to the growth of our economy, to the growth of working class families. I want to pivot to another thing that I care very much about. This is credit rating agencies. Last session, in a bipartisan way, I had the opportunity to work with Chairwoman Waters, Representative Barr, to introduce HR 6934, which requires the Fed to treat all nationally recognized statistical rating agencies, NRSROs, uniformly so that more creditworthy companies could have access to the emergency lending. I knew I would run out of time. I don't know if you'd be able to speak to the NRSRO's expansion.
Just briefly, I guess, at the very beginning of the crisis, we really had to get these facilities up and running, and we just kind of worked with the big three. We then consistently expanded over and over again, expanded the group of agencies that we work with. As you know, be happy to talk about this more offline if you'd like.
Thank you so much. Thank you. I yield back.
Thank you. The gentleman from Wisconsin, Mr. Stile, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thank you, Mr. Chairman Powell, for being here today. I want to stay on the topic of inflation. As you know, I've been a bit of a broken record on this issue because it's so important to families in Wisconsin and across our country. In fact, the prospect of rising inflation, I brought this up in our committee last July, again last December. And in those meetings, you continue to suggest that you're not ready to take action to head off inflation. And yesterday, we received more data confirming that prices are continuing to rise. And inflation is not an abstract concern. And although the White House social media team put out information that a 4th of July barbecue went down 16 cents from last year, and the Biden administration can claim what they want, but families are seeing rapid price increases with their own eyes. Now, I know it's not your role to comment on fiscal policy, but I'm very concerned with President Biden's spending plans and its impact on inflation. Last month, increase in consumer prices of 5.4% was the largest jump that we've seen since August of 2008, right before the financial crisis. And over the past year, used cars have gone up 30%, plane tickets have gone up 24%, shoes are up 7%. We've seen increases in coffee and sugar, cotton, propane, all double digits, and higher material costs have added $36,000 to the price of a new home. And I know you've responded to inflation concerns by saying that price increases we're seeing are temporary and they'll subside as supply chain and labor markets return to normal after COVID. But even if it's partially a case that inflation expectations may be changing and rising the prospects of a more persistent impact. In fact, a poll conducted recently showed that 87% of Americans said they're concerned about inflation. And on Monday, the New York Fed reported that consumers expected to see higher inflation over the medium term. Can you comment on how the Fed responds to signs that consumers are beginning to expect more persistent inflation?
Sure. So we think inflation expectations are very, very important. In a way, if businesses and households think that inflation should be 2%, then it probably will be 2% because they'll expect that and they'll demand that in effect. So we monitor, inflation expectations, surveys of households, surveys of experts, the market. You can, as you know, you can get inflation compensation readings out of the difference between tips and regular treasuries. So we look at all of those things, and I would say they all went down as a group at the beginning of the pandemic, which is not good, and they've all moved back up as a group just about to the level that I would say that is consistent with in the range of consistent with our 2% inflation goal over time. And so we watch this very carefully, and we would be very concerned if they were to move persistently and materially above 2% and would react to that.
So let me build on this discussion. I want to just build in here to the distinction between the transitory and persistent inflation, in particular as it impacts home prices. According to the Case-Shiller Index, home prices have risen more than 14% over the past year. That's a very significant increase, and it's enough to put home ownership out of the reach of some Americans. Meanwhile, the Fed is continuing to buy around 40 billion in mortgage-backed securities. And here's my concern. If inflation is, in fact, as you suggest, temporary, does the potential abatement of inflation present a potential for a reset of housing prices? And if so, what are the likely impacts both on homeowners and what will be the impact on the Fed's MBS holdings?
So housing prices, as I'm sure you know, don't go directly into inflation. That's an asset. Housing is an asset, and housing prices, that's not a factor in inflation. What's a factor is rents. And then in effect, what the economists do is they take the value of a home and they impute a rental cost to that and they add it in. It's just the way they do it. So, housing prices, they went up overall 15% last year. That's too much. That's much higher than would be a normal level for housing prices to go up. I don't know what housing prices will do in the future, but there's just a lot of demand. There are people want to live as they want to live in the suburbs now. They want to move out of cities. They want bigger houses. They've saved all this money because they couldn't travel and go to restaurants. So there's a lot of demand. So even if mortgage rates go up, as they ultimately will, I think we'll be looking at a lot of demand. Then the question will be how much supply can be brought to the market. And that's really out of our control. But as you know, if you look around your district, I mean, it's a question of zoning, it's a question of materials, labor, all those things.
But if we zero into the material costs, we've seen that about $36,000 increase in cost due to the material cost, largely inflation. Look at lumber and other areas. Maybe we'll continue this discussion offline, but appreciate your time as I'm out of time and I will yield back.
I'd be glad to do that.
Thank you. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for being back with us. Like my colleagues, I want to touch on inflation. You have described current inflationary pressures as transitory and cited supply bottlenecks and temporary factors like the high price of lumber as the reason why inflation has been high in recent months. And though this may be temporary, these bottlenecks have had real world consequences. For example, my local housing partnership had to pause the construction of an affordable housing site because of a funding gap caused by the spike in lumber prices. And while lumber prices can be tied to the previous administration's actions, I know that many are still concerned about the rise in core prices. So I'm hoping that you can help us put some of these concerns to bed. So would you tell us why you believe that the recent inflation trends are temporary as the economy reopens, and what other factors are playing into the upward pressure on prices?
I'd be glad to try. So as you know, all these industries kind of shut down a little more than a year ago on the expectation that we were looking at a really bad, difficult time. And then sooner than expected, the economy's reopened and demand for housing and demand for many other things, cars, you name it, is really high because people saved. They saved money with all of the congressional fiscal support. More than 100% of income lost was replaced. So really the consumer's in very good shape to spend. And so what's happening is there's a lot of demand, but on the supply side, it's just hard. They can't build enough houses. There wasn't enough lumber. You mentioned lumber prices. Lumber prices went way up, and they've gone way down. They're still twice as high as they were before the pandemic came, but they're way off their highs. So we don't know it, but we think that'll be the pattern for at least for some of these things, where they go very, very high and then they come down as supply and demand come together, as more supply comes online to meet the higher demand. So we have a very large but ultimately very flexible economy. It will adapt, we believe. It's not one of those economies that's rigid and has a lot of structural rigidities in it. It will adapt and fairly quickly, just as it adapted to the pandemic, much more quickly and better than, frankly, people expected. So I think that'll happen. And when that happens, we should see, I don't say the prices will come back down, but the level of inflation will return to more normal levels.
Okay. Even with the unemployment rate still elevated near 6%, the reports of employers are offering higher wages and incentives to attract workers back to work. in the workforce. And I've always said that working hard isn't enough if you don't make enough. So, Chairman Powell, what do you attribute the trend of workers receiving incentives to re-enter the workforce to? And does the Feds view these conditions as favorable, even if the reasons for them are not?
So we're seeing this particularly in service industries, where there's still lots and lots of job openings, and many people who used to work in service industries, relatively low paid jobs. What we're seeing incentives to go back in. I mean, there clearly is a very, very high level of demand for people to come into these jobs. And for whatever reason, people are taking a little bit of time to look maybe for a better job. And knowing that they're going to go back, these are people who were working in 2020 in February. They want to work. These are people who want to work, right? But they may be taking a little bit of extra time in many cases to look for a job that pays better, or that they like better, or their preferences for working from home may have changed. They might want to find a job where they can work from home. Who knows? But in any case, we're seeing difficulty in matching jobs and people up, and there really isn't a precedent. We can't look back and see, well, the last time this happened. There is no last time that this happened. So we're kind of finding out as we go. But I really do think, come back in 6 months, there'll be a whole lot of these people back to work, and wages will have moved up a little bit for people at the low end, and that's not a bad thing.
Okay, great. Well, thank you so much, and thank you for joining us today. Madam Chair, you're back.
Thank you.
Thank you very much. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Madam Chair, for holding this hearing, and thank you, Chair Powell, for being with us today and sharing your insight on recent developments in the economy. We've all seen the inflation numbers. Some may say it's only temporary, or this was bound to happen coming out of the pandemic, and there may be some truth to those arguments. But I think any economic observer realizes that usually with things like this, there's not a singular issue causing our trouble, but rather several converging factors. What is most frustrating, I think, to me, is that despite the very real inflation we are experiencing, temporary or not, and that is yet to be truly determined, and it seems that while you, Mr. Chairman, are still firmly in the transitory inflation camp, the Federal Open Market Committee minutes showed there is an increasing amount of disagreement on the Board of Governors on just how temporary it may be. And what is most frustrating to me about this entire episode is that after all of the fiscal stimulus that Congress has provided for the economy since March of last year, and now even with the greatest levels of inflation that we have seen since the financial crisis, this Congress is seriously considering spending several $1 trillion more, and most likely it will nowhere near be paid for. And I know you will not speak to the merits or lack thereof of any specific pieces of legislation, and I'm not asking you to. But as the chair of the Federal Reserve, where one of your statutory mandates is inflation control, could you provide us an expectation of the type of inflation we should be prepared for if Congress was to spend another $3 trillion in the next few months, and let's just say that only $1 trillion of that would be paid for with an assortment of tax increases?
I wouldn't be able really to provide you a real time. I mean, that's what Congressional Budget Office will be happy to do, is make that forecast for you. But that's not something I could do here on the spot.
I had a feeling that would be the answer, but I think the answer to this question is obvious. High levels of inflation we're seeing would only increase and stick around longer. We would certainly not have transitory inflation if we poured that amount of fiscal gas on the fire. I also think the labor shortage we're seeing is a big piece of this puzzle, as several of my colleagues have already alluded to. Dozens and dozens of businesses in my district cannot get people to return to work, and have critical businesses in their supply chain with the same problem. This is creating scarcity, which results in higher inflation. In South Carolina, we are returning to work at a drastically higher rate than the rest of the country. Our unemployment claims are down 93% from the pandemic high last year, leading the country in this regard. A recent survey showed that 1.8 million people have turned down work because of the overly generous unemployment benefits. And that's a large chunk of that 9 million person labor gap we keep mentioning. Could this problem be avoided if Congress simply removed disincentives to return to work, such as the unemployment benefits that in many states are in place through September?
Well, I think that's already happened. I mean, those will be expiring right in September. By the end of September, essentially all of those benefits are gone. And in many states, they're already gone, as you know, in South Carolina. So we'll see that. I mean, I think it won't, whatever effect those things are having now, it won't last much longer.
Well, South Carolina depends on businesses in other states, and when those states are not able to produce whatever is being supplied to South Carolina, it's creating a problem for my state. So I just think that we have created a disincentive to return to work, and that's not good. One last question on inflation. If the Fed were to move to increase interest rates, one result would be the increased debt service cost to the federal government's $30 trillion plus debt. Is that a factor that you would take into consideration when deciding to potentially change the benchmark rate?
No, absolutely not.
So hundreds of billions of dollars in increased cost to our debt service is not a factor in that?
No. I mean, first of all, the market will anticipate that we are raising rates, so it's probably baked into some pretty significant extent. Secondly, we borrow all across the curve. So when we raise short-term rates, it doesn't necessarily have a big effect on the government's borrowing costs very quickly. In any case, we're here to achieve maximum employment, price stability, financial stability, supervise the banks, look after the payment system. We're not in a position of considering that. And the United States doesn't have to be in a position where that kind of a consideration gets into monetary policy, and it will not.
The United States doesn't have to right now. So I guess hopefully we're always in that position. I've got a couple questions on cybersecurity. I will submit those for the record. And thank you for your time with that. Madam Chair, I yield back. Thank you.
Thank you very much. The gentleman from Massachusetts, Mr. Auchincloss, is now recognized for 5 minutes.
Thank you, Madam Chair, and Chairman Powell for being with us this afternoon. Many of my colleagues have asked some really terrific probing questions about inflation in the short term and the effects on our economy and on getting back to work. I wanted to zoom out a little bit and ask about more long-term effects. One of the trends over the last at least 25 years has been the increasing returns to capital relative to the returns to labor. And there's been a lot of good theories about why that's happening, from undermining workers' organizing power to increased automation and technology. But it's clear that it would require sort of a discontinuous event to break that trend. And this pandemic seems like it could be. We're seeing that businesses that are striving to get people back into the labor force and back to work are offering higher wages, more flexibility, better benefits, really both quantitative and non-quantitative remuneration for employment. Do you think that the COVID-19 pandemic could be a discontinuous event that could actually change the balance between returns to labor versus returns to capital, whether it could give sort of a secular jolt to workers' bargaining power in the long term?
I don't know. There are so many things that are possible, and there will be things that cut in different directions. I mean, a lot of what we've seen is just increasing returns to education, and people with relatively low skills in education having stagnant incomes and wages, and people at the high end with lots of education receiving very high levels of compensation. And a lot of that is just productivity is amplified by technology and knowledge and the ability to use it, and by globalization too. So there are a lot of factors that go into that. And the pandemic will do a number of things, but it would be hard to assess which way it will point. This is a good conversation to have, but
I hear your point about the increasing returns to education and technology. Certainly that's been evident in Massachusetts in the life sciences and clean energy and cybersecurity spaces. But there's also a huge portion of the workforce, primarily service economy workers, whose jobs are not automatable, they're not routine, either manually or cognitively, and they can't be automated. And even they have had downward pressure on their wages in the preceding decades. But now we're starting to see an uptick in what they can command in the labor market. And I think them in particular, do you think that they can have persistent wage increases over the next few years as we recover?
So I know the research you're referring to. So that is very important research that shows exactly what you suggest. And, you know, if you saw people at the lower end getting paid more, I mean, it would be hard for anybody to be against that, right? And could we be seeing that? What we are seeing is sort of entry level people going into jobs in the service sectors, which tend to be relatively low paid. That's where we're seeing the pay increases. It would be hard to say that's a bad thing, as you know, in and of itself, right? You'd want to see people getting paid well who are at the bottom end of this income spectrum. Everyone was celebrating when wages were going up for people more in the bottom quartile, in the last couple of years of the last expansion. I don't know anybody who didn't celebrate that. So it's possible, and we'll have to see.
How concerned should we be that let's put forward as a premise that we do see some of that wage inflation for the service economy? How concerned should we be that inflation for basic staples would eat up that increased purchasing power and actually be on net a negative?
You know, it's hard to say. So service companies, a lot of them do operate on a relatively modest margin and have a tendency to pass those wage costs along over time. So these are hard questions to answer in the abstract. Part of what's happening though is there will be more automation in these jobs, and we're seeing that. A lot of these jobs, we're going to find out how much those jobs can be done with automation, because businesses, we've been hearing this for a year and a half, businesses are really looking hard at that now. But over time though, that can make the people who remain in those jobs more productive, and their wages can go up as a result.
I appreciate your time, Chairman Powell. I'll yield back my time as I believe I'm at the end.
Thank you very much. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Chairwoman, and I appreciate that. Chairman Powell, it's been my observation that we are all the product of our experiences, and that things that happen to us in our younger lives tend to scar us forever. My grandparents were young men and women in the Great Depression of the 1930s. The Dust Bowl in western Oklahoma and the Southwest scarred them for life. My grandparents, to the day they died, were afraid the Great Depression was coming back. My parents were young men and women in the 1950s in a horrendous drought in the southwestern United States. The day he died, my father was convinced that this rain was the last rain. It'd never rain again. I was a beginning farmer and a college student in the 78-82 period when we went through the last, what I would describe almost as superinflation spike coming out of the Carter years, and when your predecessors decided to strangle inflation out of the system. It was really hard on me and a lot of people across this great country. So like my parents and grandparents, as I see this 5.4% year over year number in the June consumer price indexes, I'm nervous about this. When I borrowed cow feed money in 1981 at 21%, that made an impression on me. So I guess my question to you is, I'm nervous. How much longer can we sustain numbers like this before you become nervous?
Sorry, I had to unmute there. Well, as I've said before, we do expect that we'll be able to see whether the narrative we're feeling it turns out to be right. And I would say we'd be able to see that. It won't take forever for us to be able to see that. And if we do see that inflation expectations are moving up, or inflation is on a path to remain well above our goals and risk of setting us off on a period of high inflation, then we'll use our tools to guide inflation back down to 2%. So in the end, it's not going to be. In the end, it will be transitory, and people need to have faith in the central bank that we will do that. But we won't do it just because, we honestly, it would be a mistake to do it at a time when we really do believe, and virtually all forecasters do believe, that these things will come down of their own accord as the economy reopens. It would be a mistake to act prematurely. So we really have to weigh the risks of the two things. And at a certain point, the risks may flip. But right now, the risks to me are clear.
I appreciate that, Mr. Chairman. Just understand, like my elders of two generations before, I will sleep with one eye open until these numbers begin to come down. And if they do not, then I realize, like your predecessors, you'll have to take the necessary actions. Along that line, Chairman, you made clear that the Federal Reserve expects the labor force participation to gradually improve. We're all optimistic and hopeful about that. And the monetary policy report also highlights the maximum employment could look much different than it was prior to COVID-19. Can you discuss with us what you see as the potential long-lasting effects on the labor market and how the FMOC will approach the question of what maximum employment should be moving forward in the new norm, whatever the new norm is in the post-COVID world?
Sure. So I would say that patience will characterize our approach on that. But what we saw at the end of the last expansion was people staying in the labor market more than would have been predicted by the numbers. And so labor force participation kept moving up, and we didn't to numbers that people didn't think we'd see again, and well above 63%, and sustained there for a couple of years, which that was an upside surprise. What we've seen since the pandemic is a wave of retirements. So, and we won't really know the implications of that for some years, but it could just be that was a catch up for the people who stayed in the labor market. So I guess the point is we can't really know what labor force participation is going to be and what the trend will be and what the right number is going to be. Ultimately, though, you'll be able to tell with wages. You know, the real feature of our one of the features of our new framework is that, you know, we think if we don't see upward pressure on inflation and on wages, then we're not going to say that the labor market is tight, even if unemployment's really low and participation's high. We won't see that. But if we do, then that'll tell us that maybe it is, and we'll have to see where those numbers are. I think there's a as I mentioned earlier, there's a degree of humility that forecasters need to have. We have much to be humble about, and so this is another area where that's appropriate.
Thank you, Chairman, and thank you, Chairwoman, and I yield back.
Gentlewoman from New York, Ms. Cortez, is now recognized for 5 minutes.
Thank you so much, Madam Chair, and thank you, Chair Powell, for being here with us today. You know, as has been alluded to throughout this hearing, we have seen that supply bottlenecks and pandemic-related factors have been one of the primary reasons that have led to price increases, whether it's computer chip complications with, you know, delaying the production of new vehicles, prompting a rush on used vehicles, the price of lumber, shipping container logistics, etc. We know that these price increases were not caused by changes in interest rates. They were caused by supply chain complications. Now, just to reiterate, you have said that these price increases are transitory, correct?
Yes. Yeah, we said that we think they will be. We, of course, we lack certainty on that, but we do believe that's the case.
Thank you. And if drivers of recent inflation are supply chain issues and potential areas of underinvestment, do you think that these issues are best resolved through investments making that supply chain more resilient or higher interest rates?
Well, you know, if we see things that are temporary or transitory and that should move through and go away because they're associated with an event, the opening of the economy, then it would be inappropriate for us to tighten policy, which really has the point of which is to slow down economic activity and slow the recovery. It would be inappropriate. It's a difficult judgment to make, though, is the thing.
Thank you. And recently, the BLS reported that the first 3 months of 2021 were the best quarter of wage growth since at least 2001. Now, my concern, to be frank, is that, you know, a misplaced diagnosis playing out with inflation could cause the Federal Reserve to prematurely raise rates and constrain wage and employment gains that have been beneficial to millions of Americans. This means that, you know, if we do take that step back, millions of Americans, especially marginalized communities, will be left with limited opportunities to be employed at an adequate and livable wage. In fact, the FOMC is projecting multiple interest rate increases before the end of 2023 and before they project achieving the pre-pandemic unemployment rate. And at the June FOMC meeting, the median FOMC members' projection of the longer run unemployment rate was about 4%, correct?
Yes, that's right.
Now, yet before triggering the pandemic, the unemployment rate reached, or rather before the pandemic, the unemployment rate reached 3.5% without triggering inflation, correct?
That's right, yeah.
And in fact, in 2019, despite some pickup in wage growth, especially at the bottom, there didn't appear to be signs of the economy overheating. And as you said in November 2019, that the benefits of long expansion are only now reaching many communities, and that there's plenty of room to build on the impressive gains achieved so far. So if indeed there was still room to expand in the months before COVID, that suggests that with time, the economy can return to a trend of GDP and employment above the one it was experiencing before the crisis. Now, do you believe this to be the case? Do you believe that the long-term, longer run implies that 3.5% is too low? And do you think that we will be able to reach lower unemployment and higher labor force participation levels than the pre-pandemic ones?
Oh, I have every reason to think, and I do think that we'll be able to get back to 3.5% unemployment. Participation is very much affected by the age of the population. So that's I'm quite sure we can get to high levels of participation again.
Okay, thank you. And to disaggregate a little bit of kind of this line between monetary and fiscal policy, what we saw was that the World Bank recently summarized estimates from market forecasters that the United States may be the only country that will leave the pandemic with higher GDP than pre-pandemic projections had estimated. It's an enormous success, and that is GDP will actually be higher as a result or after COVID and our response to COVID. Would you say that some of the fiscal policy interventions like the American Rescue Plan, stimulus checks, et cetera, played a role in that outcome?
Oh, yes, I think so. The forecast of many is that we will be, by the middle of next year, we'll be above the prior trend, not the prior level, but the prior growth trend, which is an incredible achievement. And I attribute it to the CARES Act and the fiscal policy that went so far, so fast. I think we'll in history get a lot of credit.
Thank you very much.
Thank you. The gentlelady's time has expired. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
I think I'm unmuted.
I'm not hearing Mr. Sessions.
Is that better?
Much.
Yes, that's better.
Okay, thank you. Thank you very much, Madam Chairman. It's good to see you. Secretary, Mr. Chairman Powell, thank you very much for joining us. I wanted to have you take the majority of my time to talk with us about your 12 regional banks and what they're seeing across the country for recovery. As you see it, and these banks reporting of their successes and the things that they see as perhaps things that are inhibiting or causing you to think about your national plan around the country. Thank you.
You'd like me to talk about that a little bit?
Yes, sir.
Okay, I'd be glad to. So this is really one of the great features of our system is we have 12 reserve banks around the country. They're in every community in the country, and they come back, they extract a lot of data, a lot of information, not just businesses, it's universities, it's health centers and everything. And you know, what the story they're telling is like what we've been talking about today. You have very fast growth and a lot of money out there to spend on the part of people. You have a lot of churn in the labor market. People are quitting their jobs at incredibly high rates. You know, typically that happens when labor markets are really tight. This happens to be happening while there are a lot of unemployed people. So we've never seen anything like this. And they bring back reports about that. Businesses have a hard time finding people. people are looking for better jobs. They're taking a little bit more time to, to find the appropriate job. That's one thing. There's also a lot of unevenness. You still have sectors of the economy that are struggling to get back to where they were. A number of them are above where they were. Housing, for example. We're building more houses. We had been building more houses than we'd really seen since the global financial crisis. People see price pressures broadly across the country, as we've discussed here today. That comes back. If you look at our beige book, you'll see that broadly. It's in raw materials and to some extent in wages. You'll see that as well. So it's all the things we've been talking about. It'd be hard to summarize it, but we really do get a very nuanced picture around different areas of the country, different sectors of the economy, which I think is a tremendous benefit, to our policymaking process and also to the public. I hope that's helpful.
So Texas, that I represent, was the first city in Texas to get back to its employment rate pre-COVID. And it was done through a series of things, but I think mostly because people really did not have an opportunity to have an underpinning of money that was coming in. They had to go to work. We're not a big government town where people get out and work. And I want to join my colleagues in saying, first of all, thank you for taking time to be before the committee today again. But in that process, I hope that there's healthy debate that you not only encourage within your system, but that you also recognize that there are a good number of Republicans who believe that the government propping up the system is inhibiting actually people taking jobs, getting back to GDP as opposed to consumer price index raises. And that we really see that the short and long-term answer would be people getting jobs, going back to work, schools reopening, the success of not only the marketplace, but the stability of America as we have known her. And I appreciate you taking time today. I will be interested over the next few months that your evaluation about what is working and what is not working, if you're able to spot that in markets and actually give feedback to states and governors and the president and certainly this committee on the facts and factors that seem to be successful. I think that success that you've said today is getting us to a 2% inflation rate. I don't have any problem with that at all. I could buy that. But getting to necessarily us because we want to say somebody wants a better job, but we have record numbers of people leaving. I think we need to point to successes. And I hope one of those factors is also employment. I want to thank you for taking time. And Madam Chairman, I would yield back my time.
Thank you very much. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Madam Chairperson. Mr. Chairman, thank you for being with us. I have a few questions for you based largely on a recent New York Times op-ed written by Karen Petro. In the op-ed, Ms. Petro points out that lower interest rates benefits those with assets rather than those with savings, thereby deepening inequality. Do you agree with that assessment?
No, I don't agree with that assessment. So the bottom line with interest rates is that low interest rates support a strong labor market. They support demand and they support a strong labor market. And you saw this during the course of the last long expansion, a very strong labor market. And all of the people that we talk to many, many people out in the country, who either live in or represent low and moderate income communities or both. And and they never come in and say, wow, you really should raise interest rates because you're increasing equality. We literally never hear that from them. What we hear is they really like our policy. They like our focus on maximum employment. To say you want to focus on maximum employment is that goes in the direction of having a supportive monetary policy. So that's really what I would say to that. Wealth inequality is something that goes up, by the way, over the course of a business expansion, because people who own homes and businesses and stocks and bonds and things like that, as the economy is healthy for a period of 10 years, they're going to benefit in their wealth. does anyone seriously argue that we should try to stop that from happening by raising rates at the cost of putting people at the bottom end of the income spectrum back to work? No, of course we wouldn't do that. So I think we're doing the right thing with what we do, and we're ultimately giving people a shot to get a good job and get a good wage and accumulate that wealth.
I'm going to quickly interject. So in the same op-ed, Ms. Petro points out that companies are taking out cheap debt not to finance investments in infrastructure and workforce development, but rather to finance larger profits and stock buybacks. What's your response to that argument?
I think businesses make rational decisions generally about what they should invest in and when they should give money back to their shareholders. What that has to do with monetary policy is not clear to me. I see an economy that created 3.5% unemployment and wage gains for the lowest paid people over the last 2 years or so of the last expansion, and all of that in the context of low interest rates and accommodative monetary policy. So I guess I'm just not seeing that.
And I know the Fed has a statutory obligation to promote price stability and maximum employment. What are your thoughts on the relationship between monetary policy and inequality? What do you take to be your obligations with respect to wealth inequality in America?
We don't take inequality as a mandate. We think we can. We have these disparate outcomes in the economy over the years, which have frankly, in some cases, gotten worse. And we see those as weighing on the potential for the economy. I think everyone does. If you don't have a chance to take part in contributing to and then benefiting from the economy, then the economy is not all that it can be. Now, what can the Fed do? We can support maximum employment. That's what we can do. We can push the job market to a place where, consistent with our price stability obligations, where jobs are widely available. Really, though, we can't be the lead on that. That really, it's fiscal policy and education and things like that are really going to matter much more over time than monetary policy. But I think it's appropriate for us to call it out and to use our tools as we can.
And my final question before my time expires is about just the multifamily housing market. In New York City, we draw more than half of our revenues from real estate, and when real estate fails, it has implications for a wide range of actors. It has implications for tenants who suffer from deferred maintenance. It has implications for property owners. It has implications for local governments, which depend heavily on property taxes and sewer and water fees. And it has implications for the financial system that might have an interest in those properties. What role can the Fed play in shoring up multifamily properties and real estate in America? And that'll be my final question.
Yeah, we really can't directly operate on that. I'd say what we do is we supervise banks who do lending, and we make sure that they have good risk management practices and conduct themselves professionally and with appropriate care in the loans that they make, and have capital to absorb losses should they happen.
Thank you very much. The gentleman's time has expired. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. It's good to see you again. Always enjoy our conversations. You've been asked a lot of questions today, a wide range of topics, and by the time you get to the end of the day here, it seems like everything's already been asked. I've got a whole bunch of questions here, and you pretty well got them all, so let me go back and kind of clarify a few things that I have on my end from the standpoint of concerns. I'm also the ranking member on small business, so these things affect small businesses as well, a lot of things you've been talking about today. And one of them that's really been quite harmful is this $300 unemployment benefit. This morning there was a Morning Consult poll that came out. It said 1.8 million people turned down jobs due to the unemployment benefits. Recently there was another poll that said 40% can make more staying home than they can by drawing this benefit than they can by going to work. You indicated a while ago that you look at all the vulnerabilities. It would seem to me that this would be a vulnerability that you need to be factoring into your equations for the economy and the projections. Would you agree with that?
Well, but the thing is, those enhanced unemployment benefits are lapsing now, in many states already lapsing, and lapsing at the federal level by September. So that's, in macroeconomic time, that's a short period of time. So I think, I do think that the unemployment insurance has been interacting with other things like the lack of childcare, like schools being closed in a lot of places, fear of COVID, various things. And I think you'll see that that's no longer a factor come the fall. It may take a while for things to.
Well, I would agree with that, but I would agree with that, but I would hope that you would agree also that it is a factor right now in your projections when you see that some states, and in fact, I have an article right here from the Wall Street Journal just a couple of weeks ago that indicates that Americans are leaving unemployment rolls more quickly in states cutting off benefits. That's the headline. So it would seem to me that that would be an extraneous variable or vulnerability that you would be taking in consideration. So I guess that's just my point, is that small businesses are directly affected by this. The numbers of folks are staggering when you start looking at those sort of things with concerns that they have. I have another issue I want to talk to you very quickly on here with regards to the IMF. I don't know if you saw this article, but I saw an article today with regards to, it said that a Biden administration-backed international fund proposal to issue an unprecedented $650 billion worth of special drawing rights this year alone will also help reshape the international financial system. Would you like to comment on that? That seems to me, or have you seen the article, or are you aware of it, or?
So I'm familiar with the issue, and it's very much an issue for the Treasury Department and maybe for you, but it's not an issue for the Fed. We don't have any role in that at all.
Well, as the article goes on here, it talks about affecting the reserve currency status of the United States. So I would think that that would be a pretty important take on that for you, would it not?
Yeah, again, the SDR issue is to do with funding the IMF. We are not, it would be hard to say that single action will be the thing that threatens our status as the reserve currency. And, we don't have, the Fed doesn't own own the reserve currency issue. That's an issue we share with other parts of the government as well.
Just quickly, I know the Chinese are trying to economically compete with us. Would you say that they are trying to weaponize their economy against us to try and take us over? Would that be a fair statement?
I would go so far as to say we certainly are in a strategic and economic competition with China, but ultimately these questions about competition with other countries are really for the government, for the administration, not for the Fed.
Well, all due respect, sir, this morning this hearing is about monetary policy and the state of the economy. It would seem to me that things that would affect the economy, challenges to our economy, would be something to be talking about, especially when it's monetary policy. And it would seem that the Chinese, if our money and investment money is going over there to empower and help their economy against our economy, it looks to me like that would be something of interest to you, would it not?
Those are issues that they're absolutely in the province of the Treasury Department and the administration and the Congress. You've given us powerful tools and independence and all that. And if we wander all over the landscape taking on issues that are really not assigned to us, then I'd have a hard time explaining to you why we should be independent.
Okay. Mr. Chairman, I appreciate your conversation this morning. You're not really going to disagree on this one, but I think it is a very important issue with regards to our economy. Thank you very much, and I yield back, Madam Chair.
Thank you. The gentleman's time has expired. The gentlewoman from Ohio, Mrs. Beatty, is also the chair of the Subcommittee on Diversity and Inclusion. She is now recognized for 5 minutes.
Thank you so much, Madam Chair, for holding this hearing today, and to our ranking member. But also, let me just thank you to my friend, Director Powell. Thank you so much for being here and always being willing to reach out and discuss whether it's monetary policy or if we're looking at forecasting of what the future looks like on the state of the economy. First, I know you don't weigh in directly, but I think it's worth me noting that as I've been looking at the vacant seats there is a vacant governor's seat at the Federal Reserve that has not been appointed yet. I know it's appointed by the president, but just to FYI to you, I'd like to see someone nominated with more diversity. You know, we've had long and ongoing conversations about diversity. But today, I want to ask the question, we've heard a lot because of the pandemic, and as you stated in your monetary report, which I've had an opportunity to go through, thank you. We've heard a lot about housing costs, lumber, et cetera. But housing is so important to us. I serve on the housing committee, and purchasing homes has continued to have an upward trajectory, especially in cities in the Midwest like my city. And despite the strong housing market, the Federal Reserve has continued to purchase mortgage-backed securities by $40 billion per month. Can you briefly explain the Federal Reserve's thought process on the need for these purchases, and if these purchases will have any effect on the cost of housing?
Sure. So we buy treasuries and mortgage-backed securities, and we really buy them for the same reason. We're not trying to. They're not intended to provide support directly to any industry, and including the housing industry. That said, low interest rates and asset purchases like that do keep longer-term interest rates low. They do support low mortgage rates, which does indirectly support or directly support the housing industry. So, but it's not that we're looking at the housing market and thinking this is for the housing market. It's really more that we want to support overall demand. And we want to support demand because we're still a long way from maximum employment. And we think it's appropriate. Even once people go back to work, start going back to work at higher rates, which we expect later this year, we still think it'll be, some time will have to take place to, for us to get all the way back to that place where we were in February of 2020 and or a place like that. That makes sense. So
let me quickly go to my second question. In the first few months of 2021, the price of lumber, and we've heard this earlier, skyrocketed to more than $17.30 per thousand board feet in May. But in the last few months, suppliers come back online. Prices have plunged to 60% and now are negative for the year. Is this the type of transitionary inflation that the Federal Reserve was anticipating? And how do you differentiate between the rising prices due to supplier constraints as a result of the pandemic and the potential long-term inflation?
So broadly, yes, that's the kind of thing that we'd like to see a lot more of. I mean, I wish we had seen more of it. Lumber, of course, is a great example, but we'd like to see a bunch more examples. But it's the same story. It's a situation where there's a shortage, there's a lot of demand, supply can't react, prices go up. In the case of lumber, there's just a lot of buying, almost panic buying. And we may be seeing some of that with used cars right now, where we have very, very high rates. But that's one of the things we expect is that our very flexible economy will equilibrate supply and demand, and you'll see inflation move down and maybe even have the prices themselves move down as we did here.
And that is a great answer, because that's another reason when we talk about infrastructure, we should be talking about housing and the supply and demand for housing. My last is basically a statement, my last 30 seconds. In your report, you have an area that's called special topics, and it talks about the uneven recovery in the labor force participation. You might want to take a look at it, because when it talks a great statement, it makes a true statement that factors are still contributing to the disparities with certain populations, whether it's age, poverty, or race. Black Americans are not listed. And let me make it very clear. When we talk about unemployment rates, when we say it's great for America, it's double in the negative for Black folks, that we're still struggling. You mentioned Hispanics, but there is no mention of Black Americans. So I'd like somebody to take a look at that, because we still are dealing with very high unemployment rates.
Thank you.
Thank you very much. The gentlelady's time has expired. The gentleman from Michigan, Mr. Benzinga, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. And, there's been a lot of discussion about lumber from my colleague from Ohio who just discussed that. as to whether how that may or may not indicate transitory inflation as it actually buys lumber. One of the things that I do is we have a real estate developing firm as a family, and we are also in the sand and gravel operation. So I'm intimately involved in construction. I can tell you that the lumber that I had to buy at the beginning of this year, which is currently building the home that is hopefully going to be occupied, was going to be beginning of August. Now it looks like it's going to be more like middle of September because of supply constraints, labor constraints, demand, all the things that are going on. I'm not going to be able to lower that price of that condominium because of current lumber prices. Those are baked in and fixed. And that's what I think a lot of my colleagues aren't really understanding the effects of what those price increases mean in the longer run. And at the end of the day, I wish I could. I wish I could go back and rewrite that contract. But when it's already stick and concrete in the ground and it's going up and it's got a roof on it, I can't do that. So that's going to be a problem that I think this administration is going to have to wrestle with. And Mr. Powell, I know you've had a lot of discussion about inflation today. I'm not going to dive too deep into it, but I needed to make sure that I lent my name, and as people are having the tally of who was bringing up inflation, I wanted to be one of those people. I didn't think I'd find myself in agreement with Larry Summers on some of his concerns about what's been going on with inflation. But whether it's Larry Summers or NFIB, which is saying that nearly half of all of their members, by the way, I'm also a member of NFIB, that they have had to do price increases which are affecting their customers. We've got to keep an eye on inflation. And my parting thought on this is, what I'm afraid of is we won't know it's too late until, frankly, it's too late. And that is the problem with having such a retrospective look back when you're diving into those numbers. So you don't have to respond to that. You're welcome to if you would like to. But I do want to hit on LIBOR. This is something that has not been brought up today. You have been very committed in your support, as well as other financial regulators, of completing the conversion away from the LIBOR-based interest rate benchmarks. It's absolutely essential, I do believe, to provide certainty for those tough legacy LIBOR contracts, and you have expressed that in the past. You've also stated in previous testimony that although the secure overnight rate funding rate, or SOFR, will serve a significant part of the market, you said, quote, market participants should seek to transition away from LIBOR in the manner that is most appropriate given their specific circumstances, close quote. And I've heard from many financial institutions in Michigan and across the country that SOFR doesn't necessarily fit all of their needs for their various sized institutions. Last few weeks, we've heard rhetoric coming out of members of the FSOC about the need to put parameters about the choice that financial institutions have to determine which benchmark replacement works best for their institution, their customers, or their lending activity. And while I agree there needs to be a standard for a qualified labor replacement rate, I'm concerned that some of the most recent statements sound like the Federal Reserve and other U.S. financial regulators may be changing their previous views before this committee, suggesting that SOFR, a rate based on the repo market, a market dominated by the largest money center banks, should be imposed on every institution and borrower as a one-size-fits-all solution. So, Chair Powell, is the Federal Reserve's view that there should be a choice among qualified benchmarks as it relates to those regional and community institutions that believe there are more appropriate options other than SOFR, given their business model, lending activity size, and customer base?
Yes, I mean, honestly, I think we've been pretty clear on that. We think use of SOFR is voluntary, and market participants can use other suitable replacement rates if they see fit.
So that SOFR needs to be put into legislation, or does there need to be more of that hard legacy escape and certainty on that?
So I do think we need legislation for the hard tail, as you say. I think it would be appropriate to have SOFR in the legislation, but not as an exclusive thing. I mean, it's going to be the rate for, at least for capital markets and derivatives and things.
It's not 60, it's 50.
I look forward to continuing this conversation.
I'd be glad to.
Okay, thank you.
Thank you very much. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship and Capital Markets, is now recognized for 5 minutes.
Thank you. I want to thank and agree with the ranking member. Our witness deserves a second term. I want to thank Josh Gottheimer for bringing up the importance of the state and local tax deduction. And Mr. Benzinga focused our attention on LIBOR and its great importance. And Mr. Chairman, I know you've testified just how critically important it is that we have federal legislation in that area. I do want to correct any misconceptions about the legislation that I'm proposing. It is not the purpose of the federal government to impose SOFR on any institution anywhere in the country that writes a good instrument and specifies whatever rate they want. I'm old enough to remember that most mortgages that were adjustable were 11th district cost of funds, if they want to, whatever they want to use. The question is, do we want to have a voluntary system where the instrument doesn't specify what rate to use? And if voluntary means, well, the creditor volunteers one rate and the debtor volunteers another rate, then my friends in the trial lawyer field will have a heyday. So the focus here is not to force anything on anybody if they draft an instrument that specifies what they want. But if they have an instrument that from which no one can determine what is the amount of interest to be paid, we need to provide that answer. We have to do it in a way that we are not indicating that SOFR is the standard to be used in instruments going forward. It is not the federal rate. It is not the preferred rate. It is not the rate that small banks will choose to use in many cases in their instruments in the future. I want to thank the chairman for his testimony in the past on the importance of wire fraud. I'm disappointed that you're not moving toward a payee named system for wire fraud, but I'm pleased that you're looking at other ways to make sure that we don't have people who wire their money to account 1, 2, 3, 4, 5, thinking it's going to the person they're buying a house from, and instead it's going to a Nigerian prince. I want to applaud the Fed for consistently year after year remitting $50 or $100 billion to the federal treasury in effect profit. And I know that this is unintentional. I think you should focus on it because it is very important. As to Fed currency, a federal digital currency, Chairman Powell, is it the intention that any such currency would have fully implement the Know Your Customer and anti-money laundering standards?
So we're at the very early design stages, but the answer to your question is going to wind up being yes.
Good. And you've said that that crypto wouldn't wouldn't become a currency. Crypto means hidden, and that is the great advantage that cryptocurrencies will have over a federal digital currency, because they are designed to be crypto, hidden from the U.S. government, especially the IRS. And of course, that pleases what I call the anarchist pseudo-patriots, who half the time are telling us that the federal government needs to enforce laws and have a strong foreign policy and enforce our sanctions and achieve our national security goals without deploying our troops. And they spend the other half of their time being delighted whenever anyone strikes a blow for liberty by evading our tax laws, our sanctions laws, et cetera. Looking at fiscal policy, you can't determine or project monetary policy without some guess as to what our deficit will be. What do you use when you tell us what you're intending to do with monetary policy? What is your expectation on the level of the federal debt?
Well, it's not so much the level of the federal debt. You know, what we're looking at is basically spending and deficit spending and that kind of thing. It's just we make, and by the way, the assumptions we make are in the middle of the road. It's just right out of what CBO would say.
My time is expired. Thank you.
Thank you very much. The gentleman's time has expired. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Good afternoon, Chairman Powell. Good to see you. Thanks again for your leadership. I want to, inflation is the topic of the day. I want to talk a little bit about timing and communication of normalization with the backdrop of accelerating inflation. And I understand your position that some of this is transitory and supply chain bottlenecks that could work itself out. I also recognize the slight change in the inflation targeting framework that you're working under. But I do worry that if inflation expectations continue to rise, regardless of these supply chain issues that resolve themselves, that you could have a self-fulfilling prophecy and inflation could get away from the Fed. So my question is, given the fact that the FOMC has committed to communicating any shift in the pace of asset purchases well in advance to ensure market stability and clarity for market participants, I worry that these movements in CPI and other inflation metrics in recent months have proven to be pretty rapid and significant. Is there a risk of upward price pressures outpacing the Fed's preferred timeline for communicating adjustments in its balance sheet policy, and when you start the tapering process?
No, there's nothing in the guidance or in our framework that would prevent us from doing the right thing at the right time.
Okay. So you do not believe that inflation could move so quickly that the Fed would be forced to make asset purchase adjustments or even increase the Fed funds rate precipitously without the requisite communications runway?
That's a separate question. I'm just saying we can deal with whatever happens with inflation within the context of our framework and within the context of our guidance. I don't expect the outcome that you're talking about, which would be very surprising if something like that happened, where we really had to move very quickly. It doesn't tend to work that way, but I think we're in a good position to move as is appropriate, no matter which way things go.
You probably saw, Chairman, the Wall Street Journal article today. Higher inflation is here to stay for years, economists forecast. What do these economists have wrong that the Fed has right? In other words, why is the consensus at the FOMC that, maybe with the exception of Mr. Kaplan with the Dallas Fed, that this is transitory as opposed to a sticky inflation? Why are these, in your judgment or the FOMC's judgment, why are these economists wrong? And speak to this issue about the self-fulfilling inflation expectations and why that's not a concern.
Okay, I'll come back to that, but I don't have that survey in front of me, but I think that you can correct me here, but I think that the median estimate for inflation for 2022 was in less than 2.5%, which would be, and that's CPI, or maybe it was PCE, I don't know, but that would be much more consistent with our framework than with what our critics are saying. That would be very much in the range of what FOMC participants are expecting, or at the high end of it, but within that range. Okay, so I think that's what you may have in front of you, Congressman. I don't know. I don't have that.
So here's what we as members of Congress are hearing, and I know you get this data and also anecdotal evidence filtering up through your district banks. But I just spoke to the Chamber of Commerce in Central Kentucky at lunchtime today. This inflation concern is real. It's not just that lumber prices are up and the home builders are upset, and it's not just that the fixed income seniors are upset because the price of food is up and the restaurateurs are having to pay more. for the price of food. And the trucking companies and the commuters are having to pay more for fuel costs. We're hearing that according to the NFIB, 47% of small businesses raised average selling prices in June. That's the highest since 1981. I hope this is transitory, but I hope the Fed is hearing the same thing that we're hearing.
So we are. We have this, as you know, we have a great network through the reserve banks. We hear that through a loudspeaker every day. We are absolutely hearing that. Let me get back your earlier question, if you want. I can go back to expectations.
Sure.
That is absolutely the thing we monitor carefully, and we don't see problems on that front. But if expectations do move up in a way that is troubling, which is to say materially above and for a persistent time, we would be concerned and we would react to that.
I appreciate your vigilance, Mr. Chairman, and I yield back.
Thank you very much. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee of Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Mr. Chairman, for being here with us today. And let me preface my one question by saying that we have been working with your staff on the issue of CRA. Our chairwoman has made affordable housing appropriately and necessarily the major issue of our time, and hopefully the whole nation is going to be focused on it, even as we're struggling with the short-term inflation. So thank you for your participation and support. I hope the OCC can participate as seriously as your staff has. But my one question is, although I represent Missouri's 5th Congressional District, I was born and raised, all my family members are still in Texas, and a local TV station down in Dallas, did an investigation, and it was very alarming because they found that the lack of banking services in low-income and minority communities in Dallas County, south of I-30. I don't expect you to be familiar with that, but the Community Reinvestment Act requires that banks draw assessment areas that meet the credit needs of entire communities. And this TV station, WFAA, found that 20% of banks in Dallas County, that is, drew maps that exclude all or parts of southern Dallas County. Southern Dallas County. And in one example, a bank in Dallas County was found to service all of Ellis County, where I was born, Eric, Summersville, Hood, Parker, and Tarrant, which is Fort Worth counties, but only the half of Dallas County above I-30. And so the Federal Reserve identified no evidence of discrimination. The CRA, though, requires that assessment areas contain entire counties, cities, or towns, and not arbitrarily exclude low to moderate income geographies. I'm just rambling on, but let me ask you the question, and that is, what more needs to be done to ensure that bank that bank assessment areas incorporate not only tracts where banks have significant activity, but also low to moderate income or minority communities within the same geographical areas where lower bank activity actually may reflect, not for sure, a legacy of redlining or discrimination in housing and in finance sectors. So I apologize for going on and on, but I needed to go through all that to get that question to you.
Well, thank you. And you or your staff brought this article to the attention of our staff, who brought it to my attention, and I've had a chance to look at it. And yeah, it's very troubling on its face, the article, and it just shows, I mean, we need real vigilance in making sure that banks honor their obligations to serve minority communities, low and moderate income communities, minority communities within their operating areas. And so that one got our attention, and we can't talk about individual institutions, of course, but we take this very seriously, and we appreciate your bringing it to our attention.
All right, thank you, Mr. Chairman. I yield back, Madam Chair.
Thank you very much, Mr. Cleaver. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes, and we're certainly going to hear about what's happening in the automobile industry.
Well, thank you for that lead-in, Madam Chairman. And, Chairman Powell, I'm actually sitting here in one of my car dealerships in Texas and listening to how used car prices are driving inflation, which they do, but I can't, with that in mind, I cannot say that this is the very best time to trade your car in. You're going to get more than you ever thought you'd get. So, but it is an issue. The idea that used cars are appreciating is something that you would have never thought you'd said, but we're seeing it as we speak, and that is a truth. I want to thank you for coming today. And yesterday I had the pleasure of speaking with some Main Street American business leaders, of which I am one, as you know, and how they've been recovering from the COVID-19 pandemic in the Small Business Committee, where we talked to them. Some of the issues that were brought up were that these businesses were having trouble finding workers, as we talked today, inflation increasing and the cost of goods, and that they are purchasing from their large suppliers, they're paying more, and then the threat of tax increases. Now, one business owner in my district from Cleburne, Texas, which Congressman Cleaver knows where it is, reminded us that this isn't very complicated. Small business operate on very tight margins, and any increase in the tax rate is detrimental to the abilities to operate. So specifically, he mentioned that they were looking to plan out their capital expenditures for next year. They've already begun investing less, simply because of the threat of higher corporate and capital gains taxes coming in 2022. So I want to make sure that the factors that the Federal Reserve is tracking, which could be a drain on the economy, are aligned with what Main Street America's fears are that we're hearing from business people all over the country, and certainly in our state and our district. So Chairman Powell, as you look at the economic outlook of our small businesses and the country moving forward, can you talk about some of the factors that could be limiting growth that the Federal Reserve is paying attention to?
I'd be glad to. I've got to say, the first thing that comes to mind is difficulties, challenges in hiring. We're hearing that very, very widely. If you look at our beige book, in all districts, small businesses are having a hard time hiring. And it's, again, widespread, and we think that will abate, though, as the factors that I talked about today as being passing will be gone later this year, and we'll see a lot of hiring. That's one. I think there's a lot of optimism. There's a lot of demand. People have money to spend, so we're hearing positive things about that. I know people are very worried about inflation too. We hear that loud and clear from everybody. It's cost of goods sold. It's really going through the economy and through every business. And as we've discussed a lot here today, it does have the feeling of something that is associated with the reopening of the economy, and that things should settle down as the economy is fully reopened and supply and demand recalibrate, and maybe prices move around and people get into their new job, and we're in a new normal, I hope soon. But as of right now, it's it's something that's on every small business person's mind.
Well, thank you. I wanted to get your quick take on the speed that the private sector was able to get COVID relief money to those in need. We've not seen the same success through the SBA's shuttered venue program, which created back in December, and still hadn't gotten out the money to many of these struggling businesses. So moving forward, do you think we should be looking to get the private sector more involved as we deal with distributing government aid?
That's a question for you. I will say, if I may, the real way that our lending programs, the emergency lending programs, worked was they agitated or they supported as a backstop private markets to work. And having the private markets step in and make the loans was just so much better than having us make the loans. And having those done. So in that sense, it really worked. That the backstops did. They didn't have to make the loans because the market started working, and that's always a better answer.
Well, thank you. Let me real quick. Can you elaborate on what the Financial Stability Board means when it says climate-related risk might be transferred or amplified. And can you give me a quick potential scenario or example?
So I think, without having it in front of me, I think what the FSB would mean about that is that the financial sector, financial institutions could amplify a risk, and it would be along the lines of changes in the climate that had very bad effects on on a particular agricultural area, for example, over time, and that bank failures have a way of amplifying shocks rather than absorbing them.
Okay, thank you. I yield my time back, Madam Chairman. And just in closing, this is a great time to buy a car.
Thank you very much. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
And Chair Lady, I would just want to say that my great colleague, Congressman Williams, is not only just a great entrepreneur in the car business, he is also one of the great all-star third basemen for my Atlanta Braves in Major League Baseball.
That's
yes,
right.
Indeed.
That's right. Well, thank you for reminding us.
All right. He's a good man. Chair Powell, it's good to have you back. Now, last month, you stated before the House Select Committee on the Coronavirus, you said this, and I quote, you said, a recent decline in commodity prices was evidence that price pressures will cool as supply bottlenecks from reopening the economy are worked out and stimulus fails, maintaining that our concurrent inflation is temporary and would eventually move back to 2%, to a 2% target. So I want to ask you, while there is no doubt that soaring prices for commodities have fueled a sense of optimism for our farmers, our agriculture producers, this growing season, given the volatility around the price of commodities, are your views on price pressures still the same today?
So I would say, we continue to see prices come in and this week exceed our expectation. And that's not what we're hoping to see, but this latest CPI reading was above where forecasters thought it would be, pretty much all forecasters. So, but yeah, it's still the same story. It's still the same parts of the economy that are producing this inflation. It's a pretty narrow group of things that are producing these high readings. But we're anxious, like everybody else, to see that inflation pass through.
Well, thank you for that answer. And I agree that a return to a more stable inflation rate would be indeed advantageous to our economy. But as we know, the increase in commodity prices drives up consumer prices over the long term, even after inflation returns to normal. And unfortunately, wage increases will not keep pace, creating real hardship for people on fixed incomes, retirees, and many of our low-income households. So let me ask you this, considering how the incremental wage increases failed to keep pace with the rising cost of living, can you elaborate for us on what trends the Fed expects to see between commodity inflations and earnings, at least until we return to a 2% inflation rate?
So we don't have any ability to forecast commodity prices any more than anyone else does. They do what they're going to do. Our expectation is that over time, the reopening of the economy will be a process that we go through, and that these imbalances that we're seeing will abate. And we hope that happens sooner. It's very difficult to say exactly when that will happen. It seems likely that it will happen, but the amounts by which inflation will move up and the timing of it passing through are very hard to predict.
Well, how much time do we have? I mean, how much longer will we be in this thrust? I mean, you feel confident it will happen. What is your best estimate about when we will be back to normal?
So I think we'll know before we get fully back to normal. I think we'll know generally whether this framework for understanding it is the right one. So we would want to begin to see more things like what happened with lumber. We'd want to begin to see more of these prices flatten out and then perhaps come down, hopefully, as lumber did. And we'd like to see, that's what we'd like to see. And ultimately, though, price stability is half of our mandate. And if we see inflation moving up in a way that's really troubling and that risks a period of troublingly high inflation, then we'll use our tools to bring inflation back down to 2%.
Thank you very much, Chairman, and you're doing a great job. Keep it up.
Thank you very much. The gentleman's time has expired. The gentleman from Arkansas, Mr. Hill, is now recognized.
Well, thank you, Madam Chair, and it's great, Chair Powell, to see you, have you back before the committee. All of our members really appreciate the chance to visit and seek your wisdom on all these topics. I do hope the Fed is right that this persistent inflation that we're experiencing, record high inflation for many, many years, is in fact transitory. Super important to that family here in Central Arkansas that only has $48,000 in median income when they're all telling our offices that they're seeing such persistent and large price increases from their grocery cart to their gas to their home improvement projects. And it's a big difference for them than it is for some economist at the Federal Reserve that makes $175,000 a year and gets to work from home and doesn't bear all those normal challenges that a family here in Arkansas has. So I hope the Fed's committee is right that it's transitory. Since the beginning of January 2021, the balance sheet of the Fed's increased $750 billion. We're now over $8 trillion at the Federal Reserve. And as we've talked today, you continue to purchase about $120 billion in assets per month, $80 billion in U.S. Treasuries and $40 billion in agency MBS. Of the total balance sheet, that makes up about 29% of agency MBS and about 63% in the U.S. Treasury securities. Is that approximately right?
Sounds about right.
And Chair Powell, isn't it true that in the recent July monetary policy report outlined that the, quote, housing sector remains remarkably strong, close quote? Is that, I know you've testified some about housing today, but that's, you agree that's what the monetary policy report says?
Yes.
So given that acceleration in home prices that you and I talked about back in February when you were before the committee, and that vigorous expansion of mortgage lending, is it really necessary to be buying the $120 billion of assets a month, particularly as it relates to the MBS portion? What's the committee's logic in maintaining that MBS portion?
So really, we look at the whole things that we're buying. It's treasuries and MBS, and they have roughly the same kind of effect on the economy. Neither of them, I mean, MBS maybe have very modestly greater effects on housing, and that's not why we were buying them in the first place. But as you know, we're in a process of looking at tapering those purchases. We had a meeting about it back in June. We've got another one in a couple of weeks, and if we continue to make progress toward our goal that we articulated last year, then you'll see us begin to reduce those purchases.
I noted that Governor Waller, made some comments after the recent meetings, saying right now the housing markets are on fire. They don't really need any other unnecessary support. Will that be taken into consideration as you look to that taper and the potential design of how one would taper?
Yeah, I would say the timing and the composition of the taper are the two main things. along with whether we're meeting our goal of substantial further progress in December. Those will be in the conversation for sure.
And help me with something that's a flow of funds contradiction for me. That is, we've got this massive, I know you don't refer to it as QE, so I'll be deferential to you, but this massive stimulus in buying $120 billion of securities monthly. And yet we've seen huge spikes in the Federal Reserve's reverse repos, which in turn drains that liquidity back out of the system, soaking it up. How does that make sense to a ordinary review? And I do think your description in the monetary policy report was good, but how does that make sense to the markets?
Well, you know that the reverse repo facility is really there to keep the federal funds rate in the target. And for a couple of big reasons, there's been downward pressure on short-term rates.
Wouldn't that indicate that there's just not that much demand to take those liabilities and invest them in assets in the banking system, that maybe we have essentially way too much liquidity on the banks of the books of the banks?
You could say there's a shortage of safe short assets, so because Treasury and so yeah, that's why that's happening. There's just a shortage of T-bills, not a lot of T-bills, and the Treasury General account is shrinking down too. So,
last topic, and we can answer this offline, but Congressman Himes and I have introduced the 21st Century Dollar Act to help our strategy for the U.S. dollar. And I'm interested in if you're going to maintain the cutoff date for our international swaps is December 31st.
Those swaps really work. They did a great job. As you know, they were a fundamental part of our program to stabilize the global financial markets and dollar funding markets in particular, which are really important for our economy. We've extended them to December 31. I made a decision not to extend them beyond that. I don't know that we would unless conditions change.
Thank you. Yield back.
Thank you very much. The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you. I'd like to first extend my apologies for having missed most of this hearing. We've actually found something more interesting than Fed monetary policy, which is a hearing I was chairing on the Science Committee on the origins of the coronavirus, which was, I have to say, a rather interesting subject. And I'd also like to thank my colleague from Arkansas for stealing the question that I was intended to ask about the differential effects of buying mortgage-backed securities versus other government-guaranteed assets. And I appreciate your answer to that. So one of the questions I have, one of the good things the Fed has been doing for the last several years is actually, instead of just publishing household net worth as if there was only one consumer in the country, but actually publishing it by wealth slices. And so you can see in your numbers, for example, that the top 1% wealthiest have about a third of the wealth in our country. The next 9% have about another third. And then between 50% and 90% have pretty much the last third. The bottom half, according to the numbers by Federal Reserve, have only 2% of the wealth. And this is very much related to how you model the economy, because there are many of the policies that we're thinking of implementing, and many of the effects of your policies that have very different effects on on the top versus the bottom. For example, things that affect stock market valuations essentially only affect the top 10% of the U.S. So do you incorporate that in your modeling when you're trying to look into the future? Are you now using economic models that look at the different behavior of the different wealth strata in the United States?
Yes, where it's appropriate. For example, much higher marginal propensities to consume among people at the lower end of the income spectrum, and lower at the top. We do incorporate those. Again, where it's appropriate, we do that. Yeah. Also, in modeling monetary policy, it matters as well. So.
Certainly, and so yeah, if you have some sort of write up on that, that you could get, I very much appreciate it, because I think that's getting the coefficients there correct are really important to to understanding how your policy decisions are going to affect not just the American economy as a whole. Do you have any general feelings on, on the apparent disconnect of the stock market with the, the feelings of ordinary families? There were instances during the COVID crisis where just there was a scream of pain from the general public, and yet the stock market was hitting record highs. What's your thinking on that?
I never express an opinion on the level of the stock market, but remember what the stock market's doing. It's pricing in future cash flows, as you well know. And so it's thinking ahead. And I think in this particular, what happened last year was pretty early on. At the beginning, there was this crash. And then pretty early on, after the CARES Act passed and the things that we did, markets really recovered very quickly, beginning pretty early, looking ahead to what became a pretty strong recovery, and markets were righter than a lot of forecasters were, because the recovery did exceed expectations. But I can't comment on the actual level, though.
And are you fairly satisfied with your response to the stress in the treasuries market? Do you need any new tools? Would you like to have any more? What's the current or the thinking in retrospect on that?
I think the work is not done there. I think we are in the middle of bringing that work to a conclusion about what went wrong, what are the right tools, how deep out into the tail do we need to insure, and all those questions I think will come around. I don't think we're done with that project at all. I think this will be over the next 12 months. Probably there'll be a lot of ideas and discussion. The idea of central clearing is out there. There are a lot of ideas.
Yeah. Well, just the imbalance of supply and demand may have been one of the critical factors there. And what you did there may actually have been very important in preserving the dollar's position as a currency that you want to have your country's economy connected to. And so that was well done. Anyway, I just thank you again. You're doing a heck of a job, and the end of the tunnel is in sight, and I hope we'll all come out of this and continue in good shape. So.
Thank you.
Thank you very much, ladies and gentlemen, members. We have a hard stop that we negotiated with Mr. Powell, and he's going to have to leave now. And so we will not be able to call on any more members at this time. But those who were not able to raise their questions or to make their statements will be first in line when he returns. So I'd like to thank Mr. Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask Mr. Powell to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. With that, this hearing is adjourned.